Okay, good morning, everyone. I see lots of people still joining. We're just over 300 of you here with us live now, which is fantastic to see. And I think that's a good marker to get started. We've got lots to cover in today's session. So welcome everyone to today's half day of training on the IFRS Sustainability Disclosure Standards. This program is really driven by that demand that we're seeing in the market for more support, more capacity building on the IFRS standards. So we'd like to firstly thank the IFRS Foundation for their collaboration and partnership on this program to really bring this capacity building to the market, and to IFC in particular for their generous support to this program. And of course, a big thank you to all of you joining us today from all over the world in today's global session. For those registered today, we had over 100 countries represented in terms of registration, which is fantastic and obviously really shows that global support and adoption we're seeing for the standards. So thanks to you all as well for taking the time to join us today. So I'll be covering from the UNSSE perspective, Fiona, some opening introductory parts shortly. But before I do, we have some high-level opening remarks which I'd like to start the session with. So firstly for that, I'm very happy to introduce today that we have Richard Barker from the ISSB board joining us. So Richard, as I said, joined the IFRS board in 2022 and has a strong background academically and across institutions in accounting. So a big thank you for being here with us, Richard, and I'll pass the floor over to you for your opening comments. Thank you.
Thank you, Fiona. Very nice to be here. Welcome to everyone to this session. Thank you to the Sustainable Stock Exchanges Initiative and to the IFC for making this possible. We've been doing this training jointly now since 2023. More than 13,000 people, I think, have been through the training so far. And as Fiona was saying, quite a lot of people are attending this session. So from all over the world, right? I've got a list here. It's in order of number of attendees: Pakistan, India, Indonesia, Nigeria, Malaysia, South Africa, Hong Kong, Ghana, Egypt, and the list goes on. 100 countries. So it really reflects the global footprint of the organization, as it were. So thank you for being here. I think just a few opening comments about S1 and S2. We, as participants will know, are part of the IFRS Foundation, which also sets accounting standards around the world. So accounting standards are mandatory. Our accounting standards are mandatory in more than 140 countries globally. There was very strong investor demand for sustainability information to understand the transition that the global economy is facing over the next years and decades. And so IFRS sustainability standards came in to fill that need and to fill that gap, as it were. And the focus is on high quality, comparable disclosure to provide investors with decision useful information. And that's what this training session is all about. It's worth emphasizing that we are at a relatively early stage in sustainability reporting in relation to financial accounting. Both form part of financial reporting, but the sustainability part is relatively new. So you're in the right place at the right time, right? You're sort of picking up this material at its early stages and at its formative stages, I would say. So S1 and S2 is our body of standards. It's in a sense not a lot and a lot at the same time, right? That it's actually not a lot in terms of words. You can get your mind around reading the standards relatively quickly, but how to apply them, how to interpret them requires a lot of thinking and practice and testing and evaluating and so on. And it takes time. We're all, relatively speaking, in the early stages of this journey. So this sort of educational session, I think, is key in that process. The slides, the content, the engagement, and so on, the design of this program is really well done. So it's designed to build not just understanding, but confidence and insight into the nature of this material. Global adoption is happening very quickly. So as I've mentioned, the extent to which our accounting standards are already adopted globally. There's about, I think it's 35 countries and so far are in the process of adopting or have already adopted our standards globally. My own country, the UK, is about to announce its consultation to start the process of adoption anytime soon. So this program, and more generally the role of stock exchanges in sustainable finance and the role of the ISSB in developing a global baseline for reporting, is all about building the readiness and the confidence to be able to explain to investors how sustainability-related risks and opportunities affect your business, and to do so in a standardized way so that investors are able to make comparisons, meaningful comparisons, using quality information across different issuers on markets. So it's all good stuff. I think you'll enjoy the session, and thank you for taking part.
Great, thank you so much for that, Richard. Super helpful way to put the session in context for everyone. So thank you very much for that. Brilliant. So with that, we now have a second brief opening comment from Relitza Germanova. So Relitza is the ESG officer and lead for the Sustainability Disclosure and Transparency Program at the IFC, part of the World Bank Group. So Relitza, again, thank you very much for joining us as well, and over to you.
Thank you very much, and good morning to everyone. I see that there's people from all over the world and all continents, and it is my privilege today to welcome you to this important global session on the IFRS Sustainability Disclosure Standards. And on behalf of the International Finance Corporation, part of World Bank Group, I'd like to extend our appreciation to our partners from the IFRS Foundation, Mr. Richard Barker, the board member of ISSB and the UN Sustainable Exchanges Initiative, and your support in making this event possible is invaluable. IFC is the largest development institution working with the private sector in emerging markets and developing economies. With offices in more than 140 countries, we operate in some of the world's most challenging markets. We have found that global standards, often designed for developed markets, require a phased approach for implementation and capacity building to be effectively translated into local context. Regulation needs education, and today's training is a step in that direction, and is a result of the partnership between UNISSC, the IFRS Foundation, and IFC. And our joint efforts have led, as Richard said, to training over 13,000 participants in more than 25 markets so far on applying the IFRS sustainability disclosure standards. To this end, the training focuses on deep dive of the IFRS sustainability disclosure standards S1 and S2. And they mark a pivotal step towards a global consistent language for sustainability-related disclosure. And since becoming effective in January 2024, 36 jurisdictions have decided to adopt them, or are taking steps to introducing the ISSB standards, covering 60% of GDP and 40% of the global market cap. And as the ISSB standards reflect increased sustainability and climate reporting requirements, they urge regulators and stock exchanges globally to adapt their listing requirements and reporting guidance to meet the investors' demand for sound ESG data. The standards also affect the supply chain companies in emerging markets and developing economies who need to provide reliable, comprehensive, and verifiable sustainability and climate disclosure. Over the past year, IFC's Beyond the Balance Sheet program and ESG advisory services teams have worked closely with IFRS Foundation to support regulators, stock exchanges, companies, and financial institutions in adopting and implementing IFRS S1 in countries like Bangladesh, Jordan, Kazakhstan, Peru, Pakistan, South Africa, Kenya, Nigeria, Nepal, and we have requests from many others. And these efforts were made possible by the 2024 MOU between IFC and IFRS Foundation. And lastly, we'd like to introduce the IFC's Beyond the Balance Sheet platform, which will be shared in the resources as a valuable resource. And you can find the link by scanning the QR code next to me and also in the chat. And this platform offers a step-by-step toolkit for preparing reports that align with ISSB and other standards, a self-assessment tool which allow companies to benchmark their practices against these standards, e-learning, and plethora of resources. We believe today's session will strengthen your understanding of the ISSB standards and support your work in advancing sustainable finance. Thank you. Enjoy your learning today.
Thank you so much for that, Relitza, as well. So brilliant. Thank you both for really setting the session in excellent context for us there. Much appreciated. So I will just take us back into the slide presentation. 1 second. Hey, thank you both again. So from my side now, just wanted to cover off a few kind of housekeeping and practical points before we get into the content of the session. So firstly, just in terms of the format and admin for today, you probably have noticed by now that we do have all of the participants muted. However, as you are already finding, the chat is very much open, and we really encourage you to make use of this opportunity to share your thoughts, exchange ideas with peers through the chat function. So please do continue to do that. We also have the Q&A box within Zoom, which we would ask you to use if you have any particular questions for the team. So if you make sure to put any questions through the Q&A box, that just ensures that the team can keep track of those and answer them for you. And we really do encourage you to make use of that functionality throughout the session as well. So in terms of how we'll be running the workshop today, so as you're probably aware, we have 3.5 hours of live training, and we have an optional follow-on homework exercise as well. As I've already said, we have live Q&A available throughout, so I think that's a really fantastic opportunity to make use of, because we have, as I'll be introducing shortly, several technical representatives from the IFRS Foundation here today who will be able to answer your questions, so please do make sure to ask those. And of course, as I said, we really do encourage your participation in the session as well, to share your ideas and continue your own learning. We'll be doing a number of interactive elements throughout, including using Menti and the polls. So please do participate in those. It's always great to see. And finally, just to mention that we will be offering a completion certificate at the end of the training program. So if you stay along with us throughout the full training, we'll share the information at the end of the session that tells you how you can access the survey as well, that will allow you to get your certificates. Great. If I could just ask a member of the team on our end, if you could put those raised hands down if possible, please, just because it's right where I need to control the slides, unfortunately. But yeah, as we said, I think if you have any questions and you've raised your hand, please do make sure to put your questions in the chat for us as well, and we'll be happy to answer those. So in terms of introducing who will be covering the content in today's training session, so firstly, you have myself, Fiona, from the ISSB team, and I'm joined by my colleague, Lois Guthrie, as well. And then from the IFRS Foundation, we have Bella and Robert, who'll be taking us through some of the content, and as I said, here to answer your questions as well. They're also joined by their colleague, Huimin Hay, Vanessa, who will also be answering some Q&A in the background too. Okay, so in terms of what we want to take away from today's session, we have a few key learning objectives. So firstly, we hope to help you develop your understanding of the ISSB standards. We then hope we'll be able to start to work towards understanding how to use the ISSB standards. And finally, identifying what steps that you can take to start to develop your disclosure plan to align with those standards as well. So keep in mind throughout that that's what we're aiming to take away from today's session. And so to break that down into a few kind of key steps that allow us to understand this better, we've developed a sort of 4-module structure that we're going to be working through in today's session, which you'll see on the screen there. So firstly, we start with the prepare module, which is all around building on your existing knowledge that you may have of sustainability reporting, thinking about the purpose of reporting, the overall landscape, and how that's developed towards the global baseline of the ISSB standards. We're then going to move into Align, which is all around setting the direction for your reporting, thinking about how you can apply and use the standards, and what additional disclosures you may need to add to your reporting to be aligned with the new requirements of S1 and S2. We'll then come through into our implement module, all around the practices and systems that you'll need to use. And we'll finish up with communicate, all around thinking about the location of your reporting and how to report efficiently to your stakeholders. And to do that, we have broken that out into the short agenda that you'll see on the screen there, kind of breaks the modules up by section. And we also, as you probably will be pleased with such a long 3.5 hours together online, we do have a short break in the middle as well, so an opportunity to refresh yourself then too. And just a few things to highlight. So Lois will be sharing the links in the chat. I know the chat might be moving quite fast at points, so please do scroll back and look for any messages from Lois or myself that might share links with you. But there will be links to all of the training materials that we're using in this session shared in the chat. These are also available in the handout materials, which you can find on our webpage. And Lois has shared the link to the SSE toolbox there, but in particular, the slides and handout from today's session as well are available on the event webpage, which you signed up for at today's session. And the recording of the training will also be there later as well after the session. And as we've mentioned already, there is an optional homework assignment. You can access this from the same page that Lois has just shared the link to, again, there at the bottom of the page. And that homework assignment is really to support you in developing that internal disclosure plan. And we'll be talking through that further during the session. Just to highlight a few more key resources that Lois has shared the toolkit link to that the SSE provide to really support you on this topic, which we'd recommend that you look at. And so with that, I wanted to move on just to a quick Menti exercise to kind of get everyone ready and comfortable using Menti and to get a bit of a sense of who's here with us today and why you are joining us. So Lois will share a link to Menti in the chat with you, but I'm also just going to share my screen now with the Menti open, so that will also give you the details to be able to join us there. Okay. So if you navigate to menti.com and use that code at the top of the screen, that's one way that you can access this. You can also use the link that Lois has just shared in the chat with you. And there's also a QR code on the screen there, which gives you a third way of joining us as well, if that's better. So I'll just give everyone a moment to find the Menti. And then if you want to tell us just in your own words, a couple of words, what your reasons are for joining us today, and maybe what you're hoping to get out of the session, that would be great. So I'll just give everyone a second to put in their responses. I see lots of you filling that out already, which is fantastic. So please do keep that up. Great. We will be coming back to Menti throughout the session as well. So encourage you to keep that open in the background after we've moved back into the presentation, because we'll use it again later. Okay. Great. I see more than 100 of you already taken part. So I'm seeing lots of different words, but I'm seeing learning, compliance, understanding, capacity building, upskilling, skills development. So yeah, exactly. All of the reasons really that we're here to join us today. And if you do have any issues accessing Menti, do feel free to do what some of you are already doing and share your thoughts with us in the chat as well. That's always helpful. Okay, fantastic. So we hope we'll be able to support you with some of those drivers for being here with us today throughout the session. And then a second quick question, just to start us off, just to get a sense of where you are with your understanding today. So getting a sense of how comfortable you are with each of these different tasks. So I'll just leave that QR code there for you a little bit longer in case that helps anyone to access. But let us know how comfortable you are, from maybe not comfortable at all on the left to very comfortable and already working on this on the right, to explain to your team what the ISSB is, to use the ISSB standards, and to develop a reporting strategy. So those kind of 3 key learning objectives that we talked about at the start of the session. Okay, so I'll just give you all a moment more to answer that, but I'm seeing probably kind of a bit of a spread overall across the session, but overall we're coming out in a sort of middle to perhaps slightly low end confidence across these areas, which of course is understandable and makes sense for why you might have joined us at today's training. But thanks for letting us know that. That's always helpful to see. Okay, so I'll take us back into the presentation. Feel free to keep letting us know in the background if you have any more answers to put in there. But as I said, we'll come back to Menti, so feel free to keep that tab open as well. Great to see so many of you participating already. Okay, so I'll move on then to kind of the first module of training now, which I'll cover before I start handing over to some of my colleagues to share their perspectives as well. So firstly, we have a brief disclaimer that we just want to share with you at the start of the training. And this is just to be really clear about how we're going to be using disclosure examples in today's training. These are really simply here to help add some color to what we're talking about. Sometimes, of course, it can help to see a real example to put into practice a discussion of what we're saying. However, what we'd like to clarify is that any examples that we use today shouldn't be seen as the best way or even the right way for a company to approach these topics. Of course, each company has its own unique circumstances and should do what suits it best. So please just take these examples as inspiration, but do keep in mind this disclaimer as we move through some examples in the session. Okay, so with that clarified, I'll be starting, as I said, just with the first module, Prepare, which is all around building that really solid knowledge foundation and building on what you might already know of standards and frameworks in the market. So here we generally like to cover three important aspects in Prepare. So firstly, we'll start with purpose. So this is really around the case for sustainability reporting, including the market and business case for your disclosures. Next, we'll move into landscape. So this is all around how the reporting landscape has developed and evolved over time and how it's becoming simplified as well. And then we'll finish up with our section on the global baseline. So this is introducing the core concepts and requirements in the IFRS S1 and S2 standards to you. Okay, so to get started with the why aspect and looking at purpose, so we're going to dive into a little bit around the market drivers for disclosure. So to help us get our understanding of that, we'd just like to start with a quick poll for everyone to let us know really what your particular drivers are in this area. So hopefully the poll should be appearing for you now. If it isn't, feel free to share your responses in the chat with us as well. But the options for you here is to let us know multiple choice, as many as are applicable for you. What are your reasons for disclosing sustainability related information? So is it perhaps regulatory requirements, sharing your management's objectives, maybe social or peer expectations, perhaps it's investor interest, or maybe you have other reasons or aren't disclosing yet at all. So if there's anything else you want to highlight in the chat to us as well, please do that and share that as well. I see lots of you participating, so it's great to see everyone's involvement there. I'll just give you all a few more seconds to take part in that poll. Okay. See the answers coming thick and fast, so I don't want to stop you too soon, but in the interest of time, I will just close the poll there and share the results with you. I hope that gave most of you time to answer. So we see the top answers coming out there as really being around those regulatory requirements and the investor interest in particular as well. But a number of you highlighting also maybe sharing your own management's objectives as a sort of key third driver, and a few of you perhaps looking at that peer and competitor element as well. So really useful to just understand those perspectives on why you might be here with us today and what's driving your interest in reporting. But I'll stop sharing that now and we'll have a look at a few kind of market drivers that might also be behind some of this. So firstly, of course, that investor angle that a number of you highlighted there is a really key reason for an uptake in more disclosure here. So we now have more than 5,000 signatories representing $128 trillion in assets under management who are signed up to the Principles for Responsible Investment. So really, that sends a clear marker that responsible business practices are becoming increasingly important and material for investors. So what's really driving this interest from the investor community? So firstly, one thing we wanted to highlight here is a key driver behind this demand from investors is understanding the financial effects of sustainability risks and opportunities. So here we see some data from a study of retail investors done by Morgan Stanley, where they found that the top driver of at least those individual investors that was driving their interest in sustainable investing was actually financial performance. So, not seeing this as some sort of nice to have or impact-driven agenda, but actually a really important aspect to understand the financial performance of a company. And so if you want to take a look at this study and any studies that we share in this session, you can take a look at the links which are shared at the bottom of the screen in the handout presentation on our website. But in the interest of time, we'll move on now and look a bit more closely at what we mean by financial performance. So it's important to remember that today we're talking about disclosing financially material information. So we'll discuss this in more depth in the workshop in terms of what we would mean by material, but we want to be clear from the start as to what sort of financial effects investors are looking to have more information of. So let's start with the effects on a company's performance. So this is often seen in the profit or loss or revenue statement. And sustainability risks and opportunities can have a financial effect by perhaps changing the mix of revenue or total revenue of a company, maybe if demand for its products and services changes as a result of these risks. And we can also see changes in expenditures. So for example, in the operating costs of a company, maybe due to increasing energy prices or the need for more R&D expenditure. So just first clarifying those two types of performance effect. And then you're also going to hear us talk today about effects on a company's financial position. So let's look at what that means. So we can often see a company's financial position on their balance sheet, known as their statement of financial position. So for example, a company might experience changes to certain assets or liability risks due to sustainability issues, and we might also see changes in overall portfolio value. Maybe we'll see potentially even write-offs of certain assets that are damaged or need to be repriced as a result of sustainability risks. And so another financial effect that could also be considered is access to and the cost of capital. And this can include as well insurance premiums that might be increased due to climate risks, for example, or maybe also positive access elements relating to access to new forms of capital, such as green bonds. Okay, so before we move into the next unit, just a couple of key more concepts that we wanted to highlight. So really, the first one is around the understanding of sustainability risks and opportunities. And you're probably quite familiar with this visual from the World Economic Forum's annual risk report, which looks at the different types of risks we see over kind of near-term and longer-term time horizons. And I think something we want to highlight from this in particular is that with sustainability reporting, we need to be considering and managing risks that will arrive potentially quite far ahead in the future. And so we might actually need to invest today in new practices or processes to mitigate these impacts now. And so what that might mean is that actually those financial effects that we just talked about could be felt in the near term, even if perhaps the risk itself is more of a medium or long-term risk. And another important aspect of sustainability-related risks and opportunity is their interconnectivity. And so another visual here from that WEF report really shows that interconnection across those different risk types. And so whilst many people might think of the two ISSB standards as we're talking about today as separate reporting standards on different topics, of course, what we can see is that all of these risks and opportunities are inherently connected. And so we really need to try and think about these issues in a holistic way when we're making strategic decisions and when we're preparing our disclosures. So that's just the final point we want to keep in mind throughout the training today. Great. So with that, that's a few of the kind of key introductory concepts established. And so I'll be handing over now to Lois, who'll be taking us through the next segment on the reporting landscape.
Thank you, Fiona, and hello, everybody. So we've covered briefly why sustainability reporting standards are important. Now let's have a look at how the standards have been developed in the landscape of existing reporting standards. Before we do that, though, let us ask you, what frameworks are you currently using for sustainability-related disclosures? So the Zoom poll will appear. You can select all of the answers that apply. Are you using CDP's annual survey, formerly the Carbon Disclosure Project? Are you using Global Reporting Initiative standards, integrated reporting, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, the UN Global Compact principles, or any others, which please do let us know in the chat So I can see some coming through that people are using the stock exchange reporting codes, for example, local laws like BISR in India, PRB, Johannesburg Stock Exchange. Yes, very interesting to find this out from you. Not sure what WEPS is, but yes, lots of different standards being used by people. So now we have over 57% participating. I'm going to end the poll and we'll share the results with you. And you can see that the majority, 67, are using the Global Reporting Initiative standards, followed by integrated reporting, the Task Force on Climate-Related Financial Disclosure, TCFD, and CDP. So a range of frameworks in use, and I can see already lots of different standards coming through in the chat. So thank you so much for sharing that. It helps us to understand the landscape. So against that background, let's have a look at how the IFRS Foundation came to develop international sustainability standards. So what is the IFRS Foundation? Well, the IFRS Foundation is a not-for-profit public interest organization that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, we see two independent standard-setting boards. In dark blue, the International Accounting Standards Board, or IASB, was formed in 2001, and as Richard Barker from the IFRS Foundation said earlier, those standards are in place in over 140 jurisdictions around the world for financial accounting and reporting. In the light blue box, we see the International Sustainability Standards Board, formed in 2021 and released its first two standards, the ones we're going to be talking about today, in 2023, following strong market demand for its establishment. Now, these two standard-setting bodies work closely together to ensure that their standards complement each other, and governance of the standard-setting boards is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. So as we saw, the ISSB was formed in 2021. So this slide shows us many of the reporting organisations that were already in existence at that time. Now you'll see lots of different logos on the screen. I'm sure you're familiar with them. Looks a bit confusing and has been described as confusing, but I hope you notice from the arrows that they're pointing towards IFRS sustainability, and actually this is a picture of simplification and harmonization, and I'll just run through very briefly why. If we take the TCFD that some of you are using, you'll see arrow pointing to the IFRS Foundation, because the TCFD's work has finished, but it has been taken over by the IFRS Foundation. So TCFD's recommendations are now embedded in the ISSB's work. The same applies to the Transition Plan Task Force, whose disclosure-specific materials are now within the IFRS Foundation. CDP has aligned its climate questionnaire with ISSB S2 on climate change, and there are three organisations shown at the bottom of the screen: the Climate Disclosure Standards Board, Integrated Reporting, and SASB, and their work has been consolidated into the IFRS Foundation. Now with GRI, there's a memorandum of understanding and work in progress to reflect the commitment the two organisations have to work very closely together to jointly identify and to align their common disclosures. So a picture of harmonisation and simplification. Let's just ask you a question now. We've just heard TCFD recommendations have been incorporated into the ISSB's work. So please select only one answer to this poll. Companies who disclose using the TCFD's recommendations automatically comply with the ISSB standards. Is this true or is this false? I'll give you a moment to think about this. Yes, we've got over 50% participation now, so I'm going to end the poll here and share the results. So 52% of you said this is true and 48% said it's false, which just shows that there is perhaps still some questions about this particular point. The correct answer is that it's false. So well done to 48% of you who said that it's false. Then the reason is, even though the TCFD recommendations have been incorporated into the ISSB's work, and S2 is based on TCFD recommendations, there are some differences. So you can't automatically assume that you comply with the ISSB standards because you are using TCFD. So let's have a look at why that is in a bit more detail. So on this slide, you can see a little thumbnail there where you can find a comparison between IFRS S2 on climate-related disclosures and the TCFD recommendations. As we've already said, TCFD's finished its work, the IFRS Foundation has taken it over. There are only really three types of differences between their work. One is sometimes different wording is used, but it means the same thing. Two, in some cases, IFRS S2 requires more detailed information than TCFD required. And the third one is that IFRS S2 requires some additional information. And this would be, for example, on disclosure of sector-specific metrics and disclosure topics, and we're going to be looking at that a bit later. So the message is, if you're using TCFD, you're going to be a long, long way towards conforming with the ISSB S2, but you can't assume it's full compliance. Now let's have a look at one of the ISSB's main objectives, which is to set a global baseline for sustainability information. I saw somebody asking in the chat, why don't we just have one standard? And certainly the ISSB's intention to set this global baseline is a step towards that. The baseline is designed to enable comparable and consistent sustainability disclosure across global capital markets. And the foundation, as we heard earlier, is working with jurisdictions around the world to achieve this through their program of jurisdictional adoption. However, the global baseline at ISSB recognizes that regulators, stock exchanges, and others might require companies to disclose further information in addition to what is required in the ISSB standards, and these are referred to as additional building blocks tailored for the needs of specific jurisdictions and stakeholder needs. So those building blocks can be required by local regulators and others, as long as the information is presented in such a way that it does not obscure information required by the ISSB standards. So what could these building blocks be? Well, they could be the type of information that GRI seeks on behalf of a wider range of stakeholders than just investors. But with this, the intention is to have a global baseline of sustainability information to which further building block requirements can be added as necessary. Just to say very briefly, there's been global backing for this intention for a global baseline and a global standard. The standards, as we know, form the baseline, IFRS S1 and S2. IOSCO, the International Organization of Securities Commissions, has endorsed the ISSB standards and asked their members to incorporate them into their regulatory frameworks. We have emerging audit and assurance standards to support the work. As we heard, I think Relita said that there are 36 jurisdictions actively adopting or looking to adopt the standards. And of course, there are moves to support people with the voluntary adoption of the standards. And this training today is an example of that. I'm going to hand over now to our colleague Bella Cheng, who's going to start to tell us about the standards themselves.
Thank you so much, Lois. And let's continue. with the standards. So now we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. So first of all, we will be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, or others. In terms of sustainability-related financial information, it is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. What do we mean by sustainability-related risks and opportunities? They are risks and opportunities that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, metrics, and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, but I encourage you to download the standards as part of your homework assignment. Let's start with IFRS S1, or to give it its full title, General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied through all the standards. And also S1 asks preparers to refer to and consider the applicability of the ISSB standards and the other sources of further guidance to identify sustainability-related risks and opportunities, and identify material information as well. The ISSB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements, not just the IFRS accounting standards. Okay. The scope of S1 is all sustainability topics except for climate, which is covered by S2. The second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the recommendations of TCFD, and it sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And also, it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required. for example, on scenario analysis and the GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So it's important to say that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Next, let's consider some of the conceptual foundation that underpin the ISSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present to a complete set of sustainability-related risks and opportunities. And fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And also, the reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the 4 content areas, and connections between sustainability-related financial disclosures and the main financial statements. Okay, now let's look at the example. So over to you, Lois.
Thanks, Bella. Yes, and just to before we dive into the example, just 2 things. First of all, if we can please remember the disclaimer that Fiona gave at the beginning, that we're sharing examples as inspiration for you rather than to suggest that they are good or best practice. The second thing is, I see some of you ask about an S1 or S2 report. As we've heard, sustainability disclosures are to be incorporated into general purpose financial statements. Now, we'll hear later that term is not defined, but there's not a separate S1 and S2 report required. And that's why in this example, which is from BHP, which is a global mining company, we see that the extract that we're sharing with you is within their 2024 annual report, and it's an extract from the operating and financial review section of their 2024 report. Now, we're sharing this example with you to demonstrate how this company has shown the sorts of things that they connect with their sustainability information. It's part of a disclosure on how BHP manages climate-related risks, how it plans to transition to a net zero economy, and they're explaining the impact of the company's climate-related risk assessment and climate scenario analysis on the business and capital allocation plans. So you can see in the first paragraph, in the underlined yellow text, the company has considered its climate-related risk assessment and its scenario analysis has considered and integrated it into their strategy, and they use that information as a sensitivity in their capital allocation processes. So immediately you can see that the climate risk assessment, the scenario analysis, the strategy is connected with what the company decides in terms of its business and capital allocation processes and the rapidly decarbonising global economy. That's the first thing. The second thing is the company tells us there are some things that is still in progress. So at the moment they're undertaking studies of physical climate related risk. But they do say that once they have the results of that, they will use the studies to inform updates to their risk profile and risk management activities. So there you see a connection between physical risk assessment, physical climate related risk assessment, and risk management generally. The last thing I want to point out from this small extract is you have this light grey text, and this points us to where we can find more information. So if you want to know how climate-related issues have impacted operational activities, you have the link and the page number. If you want to know what the impact on financial statements is, similarly, you have the link, and so on. So just a small example of the way in which this company has shown connections between information. Back to you, Bella.
Thanks so much, Lois. So after looking at real-life cases to understand the conceptual foundation of connections, now let's have another Zoom poll to test your knowledge. So the question is, what information should be considered for connected information? So is it connections between governance strategy, risk management, and metrics targets, or connections between sustainability-related financial disclosures and financial statements, or connections between sustainability-related risks and opportunities? So remember that this is a multiple choice. So choose any options that you think is right. Okay, so now we have already over 50% participation of this question. I'm going to end the Zoom poll and share the results. Okay. So as you can see, the results that 65% have chosen the option A, the four core content areas, and the 58% choose the option B, sustainability related financial disclosures and financial statements. And there 47% have chosen sustainability related risks and opportunities. Well, the correct answer is all the three aspects are the connected information. So we've already had a look at the real life cases. So I think you have a better understanding of connections and the connected information. Okay. So let's continue. In terms of materiality, yeah, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. Okay, so during the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, A number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The ISSB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the IFRS credential was also updated with more planned to come. And I've also seen some of the questions related to ISSB standards. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay. So there is another Zoom poll. The question is, water is a vital input to your business, but the ISSB standards do not currently have a specific standard on water. What do you do? And this is a single choice question, which means there is only one correct answer. So let's wait a few more seconds to get higher participation. Okay, so now I'm going to end the Zoom poll and share the results. Okay, as you can tell from the results, well done. Most of you have answered the question correctly. Yes, the only correct answer is option B, consult the sources of guidance listed by ISSB, as I just introduced in the previous slide. And the option A is wrong. Obviously, do not disclose anything about water. And you can see from the question that water is a vital input to your business, which means you can ignore this factor that affect your sustainability related financial information. And as you can see, for the option C and D, well, I think they may also be helpful, but for this question, the only correct answer is option B. Okay, so now I'm going to hand over to Fiona for the module 1 summary.
Great, thank you so much, Bella. And as she says, that brings us to the end of module 1. So to wrap that up, just a few key concepts to highlight for you here. So firstly, we reviewed the purpose of sustainability disclosures, and a key takeaway we're hoping that you'll leave with here is that there are important benefits for collecting and disclosing sustainability related information, both externally in terms of disclosure, but also internally for your business. And if you're not aiming to make good use of this information that you're collecting to improve your own strategic decision making, then ultimately you're really missing out on an opportunity here. And so then we're also here looking at the evolution of sustainability disclosure standards and the formation of the ISSB. And so when you're thinking about other voluntary reporting disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, we introduced the standards themselves and the important concepts that you're going to need to understand in order to use them correctly. And a key point I want to reiterate here is that these standards and guidance are designed to meet the needs of investors, and therefore they are heavily focused on those financial effects, performance, etc., that we talked about at the very start of this unit. So to wrap it up, we have a quick exercise for you. We're going to do this quite quickly, probably 5 minutes or so, but what we'd like to do is just to reflect on a quick question to close out this segment. So I think what we've kind of established here is really being clear in why you're reporting and what you're aiming to achieve. It's quite important. And each of the activities that we'll work through at the end of each module align to that disclosure plan homework exercise that we talked about as well. So here through the exercises, hopefully we can start to help you develop some thinking that can inform that draft disclosure plan. So the first question here is all around, how do you define the objectives for your reporting? So this is really, be clear on what you want to achieve, define what reporting requirements in particular you're looking to meet. Maybe you're looking to obviously align with the IFRS standards as we're talking about today, but perhaps you have other jurisdictional requirements or standards that build on top of that you need to address as well. And overall, what perhaps is missing from your current disclosures that would allow you to achieve this. So we'll go back into Menti now to have a think about some of those points. So if you can use the link that is being shared in the chat with you, hopefully momentarily, that will take you back to Menti, or if you navigate to menti.com, as is on the screen there, that will take you back as well. But I will just, I'll ask Lois if she wouldn't mind sharing that link again in the chat. And in the meantime, I'll open Menti so that you can see the access through that route as well. Okay, so thank you for those who've already put your responses in. That's great. So yeah, quick reminder, thanks Lois for sharing the link again. Anyone who might have closed it, you can access it using menti.com at the top of the screen there, and that code that shows as well. But thanks everyone who's already put your answers in. So yeah, just take a moment and really share your reflection on what are the objectives that you want to get out of your sustainability reporting. So I'll just share a few of the answers that we've had come through already. So fulfilling regulatory requirements and investor requirements, maybe looking at moral responsibility as well. And then we have sharing the company's mission and achievements, including impact in the sustainability related program, being transparent with the data. Yeah, exactly. So transparency with that data to your stakeholders. Let's just scroll along a little bit and sample a few more. So driving change, showing the work done by the company to achieve its science-based targets. Yes, exactly. You might have set goals that are something that it's important to continue to be transparent with your stakeholders about, but also, you may have important achievements that you've made in the business that you can use these disclosures to highlight as well. So to know more about the connection of sustainability disclosures with risks, yes, exactly. So keeping that connection. Maybe meeting carbon reduction plans I see mentioned there as well. Demonstrating commitment and accountability. Yes, exactly. So a lot of those principles that would apply for, general purpose financial accounting would also apply here. So, really being transparent with stakeholders and being consistent and reporting against those goals that you set. Okay. So I see compliance coming up and investors several times. Which of course is, a key driver for many of us here. Enhancing transparency, competitive advantages, sharing the company's mission. Yes, exactly. So, really controlling that narrative and being clear, how you're managing these issues. And I think coming back to that risk and opportunity lens we talked about, if you don't provide disclosures on those risks and opportunities, it's not that your investors will think you don't have risks. They just might assume that you're not doing anything about them. So actually being transparent with your investors about the risks and opportunities you identified and how you're managing them is a really key part of all of this. Brilliant. Thank you everyone for all of those responses. And I just see one more different perspective to highlight there around, maybe customers and buyer requirements. Exactly. So increasingly, that's definitely the case that we see purchasing requirements considering sustainability factors and reporting. So another important driver perhaps for many of you. Thanks everyone who's shared with us there. So I'll just take me back into the presentation now. But appreciate you sharing those thoughts just to get the thinking going on objectives, and you can continue to build those out, as I said, through the disclosure plan homework. But really what we want to emphasize with this exercise is that looking beyond just compliance, but actually thinking about maximizing those benefits of disclosure. So thinking about what internal use you can put this information to drive business performance, improved strategy, and ultimately to look into the future as well. So not just thinking about your current risks and opportunities, but what might impact your business's long-term resilience that you could be understanding better in the near term. Okay, fantastic. Thank you, everyone. So with that, I'll hand back over to Bella now, who'll be starting us on Module 2.
Thank you, Fiona. Okay, yes, now that we have introduced the initial concepts, let's dive into how to apply the ISSB standards, taking into account additional disclosures including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. Okay, in order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosures fit. Okay, so to begin with, let's focus first on how to apply the ISSB standards as the global baseline. Let's get started on the first core content, governance. This includes aspects that relate to the governance body in your company and how management is applied. So for each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. And for example, is management responsibility dedicated to a specific role or committee? And another question may be how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And also we can ask whether progress against these targets links to executive remuneration. For more information, you can make use of the ISSE checklist tool, but remember it's not a replacement for reading and using the full ISSB standards. Let's take a look at a couple of examples to see what we mean in practice. Okay, so over to you, Louise.
Thank you, Bella. And here we have another example, and it's from a company called Yara, which is a global crop nutrition company headquartered in Norway. They've got 17,000 employees in 60 countries, and this is an example of their governance model that comes from their 2024 integrated report. Now, there's quite a lot on this screen, as you can see. I mean, it tells us a lot about how the board and management are organized. But the three things I wanted to point out are first, if you look in the left-hand side of the column, you'll see sustainability, governance, integrated reporting, materiality processes, etc. But the reporting line for that function is through the Chief Financial Officer looking after sustainability, performance and reporting. And of course, that work is in turn filtered up to the Board Audit and Sustainability Committee, as you can see from the arrows. The second thing to point out is that the Group Executive Board receives information. You can see the oversight green arrows pointing down and the reporting orange arrows pointing up across all these multiple functions: human resources, ethics and compliance, global climate and energy, which is in a separate function from sustainability governance, but related, of course, health and safety. So the company manages the governance of these different functions through different reporting and oversight lines. That's the second thing to say. Last thing to say is, yes, as I pointed out, the arrows indicate who has oversight of information and where there's a reporting line. You can see they also talk about available competencies, and this is something that is useful in terms of ISSB disclosure, because the standards do ask you to make disclosure disclosures about the competency of the governing bodies and the management bodies that look after sustainability reporting. So there's one example of governance, a governance model, and how sustainability fits into it. Let's look at another one now. A little bit simpler here, and this is from Toyota Industries Annual Report 2024. As you all know, Toyota, a car manufacturer. So there's things to say about this simple extract. Of course, there's a lot more in their report, that you can see how often the Sustainability Committee meets once a year. And this is something that lots of companies disclose about the frequency of their sustainability committees meeting. You can see who is the chair. That's the executive in charge of enterprise risk and compliance management. We can also see that is the location or office in the organization where sustainability is managed, different to the last example we saw where the chairperson was the chief financial officer. In the middle of the screen, we can see who are the members, and also that the members of this committee come from lots of different functions across the board, including accounting, environment, HR, and other experts, including audit. And finally, you can see the actions that the Sustainability Committee is responsible for. They are to approve action plans on sustainability, determine the direction of the company's approach to sustainability, and to revise the sustainability policy. And this is useful for disclosure because the requirements in ISSB S1 and S2 do ask for this type of information. So with that, I'm going to hand over to you, Fiona, to take us through the next section on strategy.
Brilliant. Thanks so much, Lois. And I'm just going to share a quick reminder. I mentioned it in the chat as well, but for those who are asking questions, please make sure to put those questions into the Q&A box. As you can see, we're getting lots of questions throughout the session, which is fantastic. Please keep asking your questions. But if you make sure those are in the Q&A, that just ensures the team can track those and respond to them, because obviously lots of messages in the chat, it's hard to track and respond to things. So just a quick reminder on that. But as I said, please do keep asking your questions. It's great to get all of your engagement and to make the most of this opportunity live together. Okay, so with those examples hopefully helping to clarify the governance arrangement, we're now going to look at the next core content area, which is strategy. So there are more disclosure requirements under strategy than governance, but of course it's also really where a company can see the benefits from sustainability related opportunities and being better prepared for risks. So as you can see here, there are 3 high-level areas to cover in strategy. So those are risks and opportunities, the effects of the risks and opportunities, and then the resilience as well. And so we're now going to review each of these separately. So IFRS S1 and S2 disclosures on strategy are designed to enable users of general purpose reports to understand a company's strategy for managing risks and opportunities. And so if we first look at the requirements relating to sustainability, risks and opportunities, here are some questions that you'll want to ask internally. So when disclosing about risks, information required includes a description of the effects of that risk, the time horizon under which those effects are expected. And that is important there to keep in mind, as we talked about earlier in the session, that financial effects could occur either before the risk itself, if you have to invest in mitigations, or potentially later and could change over time as well. And the last 2 questions on this list in particular look at climate, and so they align with the requirements from the S2 standard. So for example, investors also want to understand what types of risks and opportunities you're considering. And here we see companies often using the categories of the TCFD relating to physical and transition risk. And both standards S1 and S2 include guidance here for companies to support them in identifying and disclosing these risks and opportunities. And it's also recommended to use industry-based guidance, for example, the ISSB standards as well. And so let's have another example here just to look at this a little bit more closely. So this example here is from Mondi Group. Mondi is a multinational packaging and paper company, and they have operations across Europe, North America, and Africa. And in the left-hand extract on the screen here, we can see a summary of the key principal risks that the business has identified and how these risks align with 4 different strategic categories for the business, spanning strategy, financial, operational, and compliance issues. And for each risk, it's useful to see that there's a delegated risk owner as well. And so within the report itself, if you look at the link that's in the handout there, you can read a lot more detail on each of these risks, but just helpful to see how they've set out clearly those risks and those issues connecting between both business and sustainability together. And then in the second side of the excerpt on the right-hand side, we see a particular look at the climate-related risks that they've analysed in further detail, using those categories of physical and transition risk and also looking at opportunities. And so as well as showing the evaluation process that they've used to get to these risks, in their report, Mondi actually explained the financial impact ranges that they expect to see from these different risks, the time horizons for these, and they also include differentiation between when the impact may start and when the full impact could be experienced. And they also look at the sensitivity of these risks and opportunities in terms of their likelihood under different temperature scenarios. So a useful example to look at in your own time, perhaps, if you want to get some ideas on this. And so we started to talk about time horizons there, and this is another really important aspect of this disclosure. So this is, as you remember earlier in the session, something that can be quite different when we're talking about sustainability-related disclosures relative to other topics. So let's make sure we're clear on what we mean by time horizons. So the standards ask you to identify within what time horizon any material effects are expected to occur. And definitions of short, medium, and long-term time horizons can vary between companies, and they might depend on a number of different factors. So they can depend on things like your investment and business planning cycles, your own strategic planning horizons, maybe the lifespan of the assets that your business operates, or a range of other factors. And so what's important to remember here is that you do need to define for yourself what those time horizons are. So don't expect that your investors will know by default what you mean by short, medium, and long term. You do need to provide a quantitative definition for that and stick to that consistently in your reporting. So moving on then to the next group of disclosures in the strategy category. The first section we talked about there was on identifying those risks and opportunities. And this next section is thinking about what exactly the effect of these risks are and where this will occur in the business. So to start tackling these disclosure requirements, you might want to start to think about questions such as thinking about what the effect would be, what your response might be to those effects, or how could you adapt to those opportunities and risks? So, just start by asking yourself these questions perhaps and start to try and build some structure around how you think about this. And again, let's have another example to see how that might look like for one organization. So here we have a quick example from BASF, which is a global chemical producer. And this is just a short summary excerpt of a lot more detail in the report, which we recommend you go and look at. But here in BASF's report, they talk a lot about the effects of different risks and opportunities across their business model and value chain. And so they illustrate, firstly, some of the different projects that they've implemented in the reporting year that form part of their sustainability strategy. And this includes thinking about their downstream supply to customers and how that can contribute to their carbon footprint reduction. And so they prioritize the projects where they see a rising demand for customers from these areas and a willingness to pay more for these areas of transformation. And you can also see that they're investing in renewable energies to operate their own plants within the direct operations as well in their own production panel of the extract. And then finally, in the downstream area there, they talk about SSS, which is referring to their sustainable solutions steering, which is really around streamlining their company's portfolio and supporting their sustainability targets. And so in the commentary that they put alongside this, they really talk about how they're trying to align across their value chain their activities to achieve their sustainability goals and take a more circular approach. So it's a good example, I think, of showing how different aspects of risk and opportunity can really affect the whole business model. And it's important to make those connections across the different areas of the business. And so when we're talking about these risks and opportunities and their effect, one of the obstacles that companies may often face when they're reporting is what amount of detail should we be disclosing here? And of course, in that example that we just looked at, that was really just qualitative information, although there may well, of course, be some quantitative disclosure in the report itself. But what about those quantitative disclosures? So under the ISSB standards, a company is required or expected to disclose both quantitative and qualitative information about the current and anticipated financial effects of these risks and opportunities. However, the standards do also set out criteria for when only qualitative information is required. And so using only qualitative information for these financial effects can be permitted either if the company can't separate the effects of a climate or sustainability risk from other effects, if perhaps there is a high degree of measurement uncertainty, or if the company itself doesn't yet have the skills, capabilities, or resources to provide that information. But wherever it is possible to quantify risks, and particularly where the effects are expected to be material, of course, it is expected that efforts are made to start to quantify that. And we have some further examples if you're following along in the handout that show you some detail on that as well. So if we ever have any slides in the handout, if you're following that aren't featured here, that's because we've included those for you to look at in your own time as well for some more detail. So now we come on to the final part of the strategy component. So we've looked there at identifying the risks, thinking about what the financial effects are, and now this group of disclosures is looking particularly at how to address resilience and preparing for the potential uncertainties we might see from these risks and opportunities. And so this really gets into the practices and processes in place to do climate scenario analysis. And so this is talking kind of particularly within the S2 standard about assessing climate resilience and thinking about the key inputs and assumptions that you're going to use in scenario analysis. So we are going to dive a little bit deeper into this area in a moment, but some of the key questions that you might want to consider asking internally when you're disclosing this information could be thinking about, overall, what is your company's capacity to react or adjust to any uncertainties, and how or where could you use scenarios? Oh, I've just asked someone, I think someone might have clicked the slides who has control there, so we'll just need to flick back through. Excuse me for that, everyone, but anyone with slide control access, please just be a little bit careful there. Sorry for that. Okay, so we'll get back into that and then we'll just look at another quick example here. So here we have an example from Stora Enso, which is a Finnish and Swedish forest product company. And this diagram is just a small visual summary of the detail in their report. So again, please do go and look at that offline to read more information. But in this infographic, they look at projecting, what the potential sales are from their different business revenue segments in the present day, but also out to 2030. And this is really showing actually how they're expecting the strategic mix of what their business does to change over time. So whereas their traditional business is all around forest, pulp and wood products, actually renewable packaging, sustainable buildings and biomaterial innovation, they see as really important future technologies and areas of growth. So that's quite interesting then to see how they're giving this sense of how the growth business will expand and how they need to then transition strategically to capitalize on these opportunities and of course offset some of that potential lost revenue from their more traditional business areas as well. And a second example that we have here, again, quite a lot of detail, so probably want to read offline as well. But this is from Solvay, which is a Belgian multinational chemicals company. And in their disclosure, we particularly want to highlight the reporting that they provide on the financial effects of their risks and opportunities. So they talk in the first segment there about their scenario analysis, talk about the assumptions they've used and how they've conducted their exercise. And then in the second disclosure segment there, they also really disclose some of the detail on what the potential conclusions are from this and what the financial effect of their different revenue segments is. So what's good to see in this disclosure as well is that they're providing a balance of showing where they might expect to see increased opportunity under different climate scenarios, but also where they might see some sales margins decrease in the future as well. So providing that balanced transparency on both negative and positive financial effects as well. Okay, so then just to close off this segment, we're going to jump back into another quick Zoom poll, which I'll launch for you now. So the question I have for you here is to just check. So a company may choose to disclose only qualitative information and or combined quantitative information about current and anticipated financial effects when, and you can select as many of these three as you think are valid reasons to provide qualitative information or a mix of qualitative and quantitative. So either if you can't separate the effects from other risks and opportunities, if there's a high degree of measurement uncertainty, or if the quantitative information sheds negative light on the company. So that was a topic we touched on a few minutes ago, Jo. So just a test if you were listening and if you kind of got the concepts that we're talking about there. So thanks for the participation. I'll give everyone a couple more seconds to respond to us there. Great. I see lots of you filling that in. Let's give a few more seconds to get final responses in. And we'll end the poll there and I'll share the results with you. Okay, so I think the majority of you are absolutely right there. The first two answers are indeed valid and acceptable reasons why it may be necessary to report qualitative information or a mix of quantitative and qualitative. But as most of you correctly identified, the third option there is not a valid reason to not disclose quantitative information. So particularly if you understand these quantitative financial effects and you expect to see negative impacts, this is really important information, of course, to be transparent about with your investors, to explain and to put in the public domain. And we saw that, of course, in that Belgian Solvay example there, that they are providing information on both negative impacts as well as positive. So important to provide that balance in your quantitative disclosures. Okay, I'll stop sharing that poll there. And that brings me on to the next segment on more climate-specific strategy considerations, which Lois will be taking us through. Thanks, Lois.
Thank you. Yes, we're moving on now to look at climate-specific considerations of your disclosure. So the governance requirements we went through earlier are very similar across S1 and S2, and really quite similar things apply to risk management in many ways. But we're going to look now at some specific things about S2 that are additional to S1. So let's start. So as we said earlier, we know that the ISSB's S2 is based on the recommendations, but not exactly the same as those of the TCFD recommendations. So we're going to have a look at what IFRS S2 says. Well, the first thing is that S2 requires a company to refer to and consider the applicability of industry-based disclosure standards, disclosure topics. So this might apply, for example, when you're thinking about the identifying sustainability-related risks and opportunities. This S2 says you must consider and refer to the industry-based disclosure topics which are based on ISSB standards for the purpose of identifying those sustainability-related risks and opportunities. IFRS S2 requires a bit more detailed information than TCFD did about where in the business model and value chain risks and opportunities are concentrated. So are there physical risks in particular locations, or are there products that are particularly vulnerable because of resourcing and so on? Thirdly, in describing the effects of climate-related risks and opportunities, IFRS S2 asks companies to disclose the effects of those climate-related risks, how the company responds or plans to respond to those risks, how the risks and opportunities were identified, and how whether the response includes, for example, any climate transition plan it has and any targets it intends to meet. The S2 also asks for information about the quantitative and qualitative current and anticipated financial effects of climate-related risks and opportunities. Now, within the standard, you'll see that it sets out criteria for when quantitative and qualitative information is required. So, for example, you are permitted only to disclose qualitative information if you cannot separately identify the effects of a climate-related risk and opportunity from other effects, or when the level of measurement uncertainty is so high that it's just not practical or helpful to disclose a quantitative result. So this is why we're going to talk about this a bit more later. The standard says that you're required to use only all reasonable and supportable information available to you at the reporting date without undue cost and effort. So you can use an approach to your disclosures that is commensurate with your company's circumstances in specific cases. So let's have an example of that. We know that the standard says that for the purposes of assessing the company's resilience to climate risk, it should use climate-related scenario analysis. But the standard does not specify the particular scenarios that must be used. That is for the company to determine based on its judgment, and the results can be disclosed in a qualitative, not necessarily a quantitative way. And finally, there are some additional requirements, i.e. additional to the TCFD's recommendations on statements made about the company's business resilience to climate risk. So in particular, information should be provided about any significant areas of uncertainty considered by the company in its assessment, what the company's capacity is to adjust and adapt its strategy and business model to build and enhance resilience over time, and of course details of how and when and which climate-related scenario analyses were carried out. So I just mentioned transition plans, and IFRS S2 does not require a company to develop a climate transition plan, but it does require companies that have transition plans to disclose information about them. So what is a transition plan? Well, it's defined in IFRS S2 as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a net zero or lower carbon economy, including, for example, greenhouse gas emissions reductions plans. So to go through the rest of these bullet points, first one, align. As the transition plan is an aspect of the company's overall strategy, bear in mind that it should be aligned with that strategy, including the business case, motivation for transition, and the levers that the company finds most feasible and economically feasible for using for the transition. Secondly, the transition plan should be aligned with science, including what science says about what's needed for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of the science. Thirdly, the transition plan should include long-term goals with clear mitigation and adaptation activities and interim target milestones. Of course, there will be uncertainties associated with the transition and the transition plan, so the plan should be transparent about those uncertainties and the factors on which the plan is dependent for progress or success, any risks and challenges to implementing or achieving it, and how residual or unabated greenhouse gas emissions will be treated. Of course, the transition is going to proceed very differently for different sectors. So where possible, the company in developing its transition plan should follow sector-specific pathways to inform its transition plan. We're going to look at some resources on that in a moment. And there are emerging hallmarks of transition plan credibility, and these are quite good tests for a company to use to see whether it's included everything in its transition plan that's normally expected, and it can give some confidence about how credible and complete your transition plan is. So let's have a quick look at some of these resources. Well, on the left-hand side of the screen, you can see a triangle. At the top is the Transition Plan Task Force work, which we know has already been incorporated into the IFRS Foundation. And under that, we see GFANS. This is the work of the Glasgow Financial Alliance for Net Zero. And they have set out their expectations for real economy and financial institutions, but they also set out sector pathways in their work, as do many other organisations. And you can see GFANS is three of their documents in the middle of the screen. At the bottom of the screen, you see the IFRS Foundation, the bottom of the pyramid, and this triangle is designed to show that all of the work builds upon each other. It's all meant to be mutually supportive, aligned, and to be used together. So now that at the end you see the TPT's disclosure framework, that forms part of the IFRS Foundation's work now. We're going to talk about the ISSB's Knowledge Hub later, and you can find all of these resources there. So, thank you so much for bearing with us, everybody. It's wonderful to see all your questions and reactions. We love that. It makes it so much more pleasurable for us as presenters. But we're now going to take a short break, 5 minutes, have a stretch, have a drink, think about any questions you'd like to ask us. We'll play some relaxing music and we'll see you back here in 5 minutes. Hello everyone, welcome back. I hope you enjoyed the relaxing music and had an opportunity to stretch and have a drink so that we can move on to the next part of our presentation. And this is on the third core content area covered by the ISSB standards on risk management. As you can see from the high-level description here, this category of disclosures asks reporters to disclose information on their processes for risk management and how they fit into their overall risk profile. So this is a bit different from what we've looked at before. We've been looking at disclosure of information about risks and opportunities and so on. This is more about processes. So the types of questions you might want to ask yourselves are what processes and policies are used to identify, assess, prioritize, and monitor sustainability related risks and opportunities, and how are those processes and policies integrated into the company's overall risk management process. So you might want to start asking questions internally about things like the inputs and parameters used for risk management, how sustainability related risks and opportunities are prioritized within those procedures, what criteria are used, for example, nature, likelihood and magnitude of risks, whether there's a monitoring process for those risks and opportunities and what it is, and whether there have been any changes to the process since the last reporting period. Some of you have mentioned ISO management processes that might be relevant here if they're used internally, or maybe COSO, the Commission of Sponsoring Organisations of the Treadway Committee, that has quite a lot of resources about a sustainability related risk and opportunity management. So let's have a look now at how that risk management applies in terms of S2. Well, as we've said, S2 requires more detailed information about the input parameters used to identify risks, whether and how climate-related scenario analysis is used to inform risk identification, and whether risk management processes have changed, in particular to take account of the very specific characteristics of climate risk, the longer time frames over which risks are meant to manifest, and the uncertainties associated with them. So you are also asked to make disclosures about the process you've used to identify, assess, prioritize, and monitor climate-related risks and opportunities, and how they're integrated into your risk management process, as we've said. Now, in terms of IFRS S2, we do have definitions of climate-related risks and opportunities, and these come from the TCFD's work. So the TCFD and the ISSB standards describe climate risks as being in two categories. Transition risks arise from efforts to make the transition to a lower carbon economy, and they're often categorized as policy and legal, technological, market and reputational risks. Now, as we see at the end of this slide here, the third column, these can have financial effects. Examples of such risks include increased pricing of GHG emissions, more reporting obligations, exposure to litigation, costs associated with the transition, in particular costs of technology to support lower emissions, changing consumer behaviours, uncertainty in market signals, and so on. Secondly, we have physical risks. Some of you have mentioned these already in the chat, and we're sorry to hear about the effects that some of you have experienced of physical risks. These include event-driven acute shifts or longer-term shifts in climatic patterns known as chronic risks. So these can be weather-related, such as storms, floods, droughts, heat waves, or reflect longer-term shifts in climatic patterns, such as increases in precipitation, rainfall and temperature, sea level rise, changes in water availability, biodiversity loss, changes in soil productivity. And again, these have financial effects on the company's cash flows, access to finance, and cost of capital over the short, medium, and long term. And of course, the standards ask you to estimate what those current and anticipated financial effects are. We see something similar on the opportunity side, where we have definitions of climate-related opportunities that can be to do with better resource efficiency, using different energy sources that are lower, produce lower emissions, developing products and services that cater for consumers who want lower climate impact products and services, entering into new markets perhaps, and building the resilience of your company. So there, all these examples are in the middle column of the slide, including things like using and developing new technologies, or perhaps supporting policy initiatives in the jurisdictions in which you operate. And again, these opportunities have financial effects on cash flows, revenue, access to finance, cost of capital, and those financial effects may manifest over different time horizons. Let's look at an example now. This is an example of climate risks and opportunities that affect NATS, which is the UK Air Navigation Service provider. It handles UK domestic and North Atlantic air traffic control, and it's from their 5-year plan. Now, as we all know, bad weather physical risks really affect airlines, airports, and passengers. And the effects on the airline industry can often lead to increased CO2 emissions as well, due to aircrafts having to circle in holes or even being diverted as airspace becomes congested and inefficient. So what the company is showing here is what they observed in 2019. So they estimated the major storms cost aviation about 2.2 billion euros. These were in terms of en route delays and increased intensity in bad weather. And you can see the bad weather effects in that first panel there, in terms of how much extra fuel was used, for example. In the second panel, we see that the company looks forward to 2050 and estimates what the effects are likely to be in terms of more delays. They will worsen by 0.5%, but that could lead to an extra 57,000 tonnes of CO2 a year. They also point to the fact that coastal or low-lying airports are an increased risk of flooding in the event of storm surge. So they also look at the outcome of these chronic changes, and that there can be some positive effects because of the way in which the jet stream and transatlantic flight durations might be affected. So in the final panel, they do look at some opportunities as well. So quite a particular example from NATS there, where they're looking at actual risks and opportunities, estimated effects in the future, and so on. So I'm going to hand over to Bella now, who's going to take us through the fourth content area.
Thanks so much, Lois. So let's continue. Well, the last core content area, metrics and targets. And now we will spend some time reviewing the disclosure requirements on metrics and targets in more detail, and the final one. Yeah. Let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. And preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. For example, what is the method of calculation? What were the inputs? Are there limitations and what assumptions are involved? And now let's move on to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So disclosures may include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or by regulation. And disclosures also include the metric used to set the target and to monitor progress toward its achievement, and the baseline period from which progress is measured, and the period to which the target applies. And disclosures also include what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. So Lois will take you through real-life cases. So over to you, Lois.
Thank you, Bella. Now, this example is a bit of an old example. You can see it's from ArcelorMittal's 2022 annual report. ArcelorMittal is a multinational steel manufacturing and mining corporation. And of course, companies are now starting to, you're seeing new reports emerging, and you've seen some examples of those earlier. But the reason we like this example to illustrate metrics and targets is that we see that the metrics and targets are linked with the company's strategy and assumptions. So what do we see here? First of all, the company sets out its ambition, and that ambition is to have a leadership position within the steel industry, and they want to achieve net zero steelmaking globally by 2050. So that ambition sets the context for targets to be set in. So what are these targets? In the second paragraph on the left-hand panel, we see the targets are to reduce carbon emissions intensity by 25% globally and 35% in Europe in 2030. We see the scope of the targets. It covers scope 1 and 2 greenhouse gas emissions for steel and mining per ton of crude steel. We also know from this that the company set out a roadmap in 2021 for achieving their medium-term 2030 targets and their commitment to their 2050 targets. So we know that these targets are set within that roadmap and within that strategy. We also see from the first paragraph the anticipated gross investment to support those targets. In the panel on the right, we see the assumptions behind the targets. So in this little extract, you find the context for the targets, which is the ambition to have a leadership position. You find what the targets are, you find the investment made, the scope of the targets, the roadmap, which sets the strategy for the targets, and so on. So quite a lot of information in a small example, but do bear in mind that this is a 2022 example and the company will have updated its report. I think it's back to you now, Bella.
Thanks, Lois. So let's continue with the climate-specific considerations. So, yeah, and we are going to talk about metrics and targets. Okay, so the TCFD framework included recommended disclosures, which IFRS S2 builds on, and S2 as part of the required disclosures. For example, IFRS S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases. S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We will share the link in the chat, and you can also find it on the SSE website. Okay. Likewise, there are some additional disclosures compared to TCFD for targets as well. For example, S2 requires disclosures about how the latest international agreement on climate change has informed the target, and whether the target has been validated by a third party. S2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectorial decarbonization approach. The questions on GHG emissions often come up in questions on metrics and targets disclosures. So we wanted to address some of these briefly. For those who might not be familiar with the different scopes, Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from our company's facilities or vehicles. And the Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And finally, Scope 3 is all other indirect emissions that occur in the company's value chain. So IFRS S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and the Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. And IS2 requires a company to disclose whether and how the company is using an internal price on carbon for decision making, and whether and how executive remuneration is linked to climate change. Okay, now it's time for another example. Over to you, Lois.
Thanks, Bella. And again, we have an oldish example here. It's from Enel's 2022 sustainability report, but it's got some interesting things in it that we hope will help you. So Enel is an Italian producer and distributor of electricity and gas, an electric utilities company. And here's an example showing just one of the ways in which Enel disaggregates and explains its GHG emissions. It's just an extract, and I can tell you from reading lots of company reports that companies come up with such new and innovative ways of expressing their GHG emissions. So at the top of this page, you can see the company's carbon footprint in the panel entitled Our Carbon Footprint. And there we see that GHG emissions are broken down by scopes 1, 2, and 3, and they show the total emissions. In the pale green bars, we see the 2021 results, and in the dark green bars, we see the 2022 results. So you can see the progression of GHG emissions over time, and you can also see which is the biggest source of emissions, whether it's from scope 1, 2, or 3, and it looks in this case like it is from scope 3 emissions. Then in the bottom panel, the company breaks down the GHG emissions by source, that is between the different business lines that they operate. So that is across generation, trading, then networks, end customers, and other sources. You can immediately see from the green bars that the Scope 1 direct emissions from generation from thermal sources, that is from the combustion of fuels in generation activities, is the biggest source of Scope 1 emissions. Bear in mind that what they're breaking down here is Scope 1 emissions across different sources. So this is not necessarily just giving us numbers, this is giving us a visual to tell us where the greatest amount of Scope 1 GHG emissions is generated. You can also see that there are little dots above against some of the numbers. Now, these dots refer to whether and to what extent the GHG emission source is considered within a science-based target. So are these sources being managed under a science-based targets initiative target? And also the numbers, the little numbers refer us to notes where we can find further information about the GHG emissions. So actually note 1 tells us exactly what types of greenhouse gases, methane for example, are included within these measures. So one little diagram, lots of information in it. And we're going to do a Zoom poll now, get you involved. And the question in this Zoom poll is, what is the objective of metrics? That is, what is the objective of the disclosure requirements on metrics? And you can select all that apply. Is it to understand the company's performance in relation to its sustainability-related risks and opportunities? To understand progress towards any targets? Or to understand the company's assumptions for the future? Give you a minute to think about that one. I see some of you asked for a little bit more time to consider these, so we're certainly going to do that. Right, over half of you have participated now, so in the interests of time, I'm going to end the poll and share the results. You can see that the answers are spread across all 3 of the options, which is fine, but the majority of you have answered A and B, which is great because that is correct. Now, it's true to say that the objective of metrics might help people to understand the company's assumption for the future. So in that sense, those of you that answered C are also correct. However, the purpose of asking you this question is to encourage you to read the standards, because at the start of each of the disclosure requirements, the requirements actually state the objective. So in the case of metrics, we refer to paragraph 45 of IFRS S1, which says that the objective of sustainability-related financial disclosures on metrics and targets is to enable users of general-purpose financial reports to understand an entity's performance in relation to its sustainability-related risks and opportunities. That's answer A, including its progress towards any targets the entity has set, and that's B. So that's why answers A and B are correct, because that's what the standard tells us. It's true the metrics might help with C, but we're just asking you this question and sharing the answer to encourage you to have a look at the standards, because understanding the objective of each of these requirements will help you to craft your answers in the most comprehensive and appropriate way. So we're going to move on now to another part of the Align module, and we're going to look at how you integrate other disclosure requirements with the ISSB's standards. So We talked earlier about the baseline. So ISSB standards set the global baseline for sustainability standards, reporting standards. But as we know, we can build on that baseline with other requirements, and they might be in the form of listing requirements in the jurisdiction in which you operate. They could also apply to your supply chain and partners. They might be additional requirements on top of the baseline to satisfy policy objectives aimed at promoting sustainability. So these could be things like information about tax cuts or subsidies that encourage sustainable practices or otherwise. There might be additional requirements that are to do with emerging industry practices that really are seeking sustainability information that's very specific to your sector. Or we might build on the baseline by adding disclosures that are designed to respond to the information needs of other stakeholders, that is, other than just investors. So we've already heard, we know that the ISSB is working with jurisdictions across the world. More than 20 have already committed to using ISSB standards, and there are others that are considering how to adopt the standards. And the IFRS Foundation gives them dedicated support through its regulatory implementation plan. If you're interested in knowing about the completed and ongoing consultations about adoption of ISSB standards, we have a link on the slide there to the jurisdictional sustainability consultations that are ongoing. So we know that there are, because we saw from your Zoom poll earlier, that companies are using different types of standards already. So the ISSB is focused on ensuring that the work it develops is interoperable with those other frameworks and standards. So we've seen, for example, that CDP has aligned its climate questionnaire with the ISSB's work, so we have some interoperability there. The IFRS S2 climate disclosure standard requires greenhouse gas emissions to be measured using the Greenhouse Gas Protocol developed by the World Business Council for Sustainable Development and the World Resources Institute. And the ISSB is actively engaged in the governance processes and updates to the GHG protocol, which many of you are probably using. We've talked already about the fact that GRI and ISSB work together to ensure interoperability between their standards, and here the slide has magically shown us the slide that refers to that, where you can see a document that tells us how interoperable the GHG emissions requirements are across the GRI and ISSB standards. So we know that in Europe, I'm not sure how many of you are attending from Europe, but we have the European Sustainability Reporting Standards developed to support disclosure against the reporting standards and laws in Europe. Of course, that is under discussion at the moment through something known as the omnibus process that aims for simplification. But the point to note here is that the IFRS Foundation and the European standard setter are committed to working together to align and make interoperable their standards as far as possible. They did a study on climate-related disclosure standards from each of the organisations and found a high degree of alignment between them. When we did the poll earlier, we saw that some of you are using integrated reporting, and as we know from what we discussed earlier, the Integrated Reporting Council's framework has been, the Integrated Reporting Council has been consolidated into the IFRS Foundation. So the Integrated Reporting Framework is a complementary tool that can be used to support IFRS S1 and S2 disclosures. So when they're used together, we have this holistic approach to the value creation process and can provide a more complete picture of how value is created over time. So there is a document to which you can refer if you'd like to know more about how to use integrated reporting to support your sustainability related financial disclosure. It includes frequently asked questions, a mapping tool, and a getting started guide to using integrated reporting. And a very important thing to note here, of course, is that what underpins integrated reporting is integrated thinking. And we see how in these documents, how integrated thinking can enhance the quality of a company's corporate governance and its approach to understanding its value creation process. So I think we're doing another poll now. Yes, we are. And this Zoom poll asks about your disclosure objectives. So when thinking about your disclosure objectives, should you consider the ISSB standards only? I think you can only answer one here. Yes. The ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and additional sources of guidance. Well, there's a very, very clear pattern emerging here. So, and 50% of you have participated. So I'm going to end the poll and share the results. Of course, you're right. The correct answer is consider all of these things, the ISSB standards, your regulatory requirements, of course, and other sources of guidance. I saw earlier some of you mentioned some of the ISO standards, including the ISO standard on water management, for example. And the ISSB standards themselves say that where there is not an ISSB standard covering particular subject matter, then do refer to these other sources subject to certain conditions. So well done for answering that right. And I'm going to hand over to Fiona to take us through a summary of Module 2.
Brilliant. Thank you so much for that, Lois. And as you say, that brings us to the end of our second module. We should say, in terms of the distribution of the content, this was quite a large module, so don't worry, we are definitely more than halfway through our training content. I appreciate all of your attention and focus as we're sort of moving through to the last hour or so of the session. So I'll just reshare. A few people have posted their LinkedIn links again. If you have shared those already, please I know a few people have shared many times, so please only share once. It's nice to share with people, but I just want to make sure we don't lose messages in the chat that we need as well. So I'll just sharing the Menti link again with you there, which will allow you to access the Menti. So just before we get into that, just to wrap up on some of the key concepts we've covered in this segment. So we reviewed all of the 4 core content areas of the ISSB standards. That's governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these don't operate in silos. So we saw in the examples from company disclosures that despite having 4 separate categories of disclosure, of course, they're all interconnected. And we also discussed what your disclosure might need to do to go beyond the requirements of S1 and S2. For example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or to meet industry standards. And what's important to remember when doing this is that the ISSB standards have been purposely developed to act as a baseline. And the building blocks approach allows report preparers to add additional disclosures on top. But in doing so, you do also need to be careful not to obscure the requirements of S1 and S2 as well. Okay, so as I said, that brings us into our next activity that we want to just take a moment to reflect on. So we've talked a lot there in a line about, what you need to do and what the different requirements are. And so what we just want to take a moment to reflect on is what are the key gaps that you need to address in your current disclosures or internal processes. So these could perhaps be gaps in your internal knowledge, your skills, your processes, or maybe there are gaps in the actual disclosure content that you're putting out or your risk management assessments that you've done to date, etc. So in order to really inform this, of course, we'd recommend that you go away and do a fuller gap analysis. There is a simplified checklist that we've included on our homework sheet that can act as a starting point to help you to do this gap analysis. and really to think about what the enhancements to your reporting might be. But it'll just be good to get an initial idea from you all now while we're here together of where you're reflecting at the moment and what some of the gaps might be from what we've heard about today. So I will share screens now to show you the Menti again. There's the question that we're asking, which is around the key gaps in your disclosure processes. Okay, and I think most of you are hopefully have been able to access Menti through the link, but I've just got the QR code on the screen briefly there. I'll remove it in a second because it does block the answers, but I know someone had asked for that before. So the QR code is there if you want to join. If you also have an option to go to menti.com and use that code there at the top of the screen. So many ways to join us, and the link has been shared in the chat further above as well. Okay, so let's see what the responses are that are coming in. I'll just remove that, as I said, so that we can see. Okay, so thinking about the differentials of scope needed to cover for reporting. Okay, so maybe that's something that you need to reconsider with this light. Thinking about the materiality assessment, I see a few of you have mentioned. Exactly, so, you know, grounding your disclosures in a clear understanding of what the material issues are for your business, particularly from this financial and investor impact perspective, is really critical here. And so that's definitely a good place to go if you know that's something that you want to do a fuller assessment of. So some people have mentioned some more technical aspects that they might want to reconsider here regarding scenario analysis, thinking about those financial effects. Of course, that's a new area for many organizations to quantify financial effects, or looking at financed emissions. So indeed, quite a common area to need to explore further. So maybe some people have mentioned as well, just, you know, knowing where to get started with this. Of course, that is one of the overwhelming things, and sometimes the hardest thing is to start. So we hope that some of the resources and checklists that we've offered you today can support you to get started and to do that gap assessment more fully, and develop that disclosure plan as we talk about in the homework exercise. So maybe the need to build out your data collection processes is mentioned. Indeed, it might be that in the past, if you've just started on sustainability reporting, then maybe you only have relatively simple systems at the moment. But if we're looking to start collecting data across a broader range of sustainability topics, that might expand your data collection needs significantly. So we're going to talk a little bit about that in one of the later modules, but definitely quite a common thing to need to start to improve. Thank you for everyone's great responses here. I see lots of answers. Hope this is helpful just to give you the moment to reflect on what you have seen so far in the training. So I see maybe internal carbon pricing flagged there as another idea. That's quite an interesting one, and I think something that may increasingly become a common topic to want to look further at. I see accountability and understanding at the board level, for sure, you know, building that buy-in, ensuring that your board understand why this is important, what their role should be in that. We know we often have indeed board members joining this training to try and find out more about this themselves. So encourage you to share some insights from this session with your board if you have a route to do so. Thinking about missing data, the scenario analysis again, just seeing if I see any new answers jumping out of me. So looking at different sources of guidance on specific topics. Of course, I think that's one of the challenges in this domain, is that there's so much guidance, it can be somewhat overwhelming to know what to follow. So I think going back to the S1 and S2 standards as your guiding light for what to disclose, but using those industry sources that we talked about and shared links to, helping to augment that understanding for your sector and for your particular company's needs. Okay, I see some similarity in some of the responses here, which is, of course, expected that people would have similar areas to look at. So maybe thinking about third-party data, the requirements that you have. I know a few people have mentioned that in regards to Scope 3 data collection, of course, being very challenging. So thinking about how you can work with your clients, your suppliers, to think about how you can obtain better Scope 3 information is certainly often a challenge as well. Lots of different answers here about climate risks and building out risk processes as well. So yeah, of course, the gaps here are going to be different for everyone. I think what's really important is just to have a clear understanding of what those gaps are and maybe an attempt to prioritize them as well. So whilst it's recognized that reporting is going to be an evolutionary process year by year, I think ensuring that you have some of those key fundamentals in place around governance and risk and data collection will set you up really well to then start to improve your reporting over time. So I think a lot of these gaps we see here are quite common and are areas we hear from other organizations as well. So a few of the things I guess we'd encourage you to think about at this stage in your reporting journey would be thinking about perhaps integrating this content into your annual report as well. So whereas maybe in the past some organizations would have published these disclosures separately, as we're going to hear more in this training, connecting that information to your financial reporting is really key here and into your financial reporting processes. So that often we know can be a new area. And thinking really about the auditability and controls around this information too. And again, another area we're going to go into later, but possibly a gap that some organizations may know that they need to improve on. But thank you, everyone. I'll just scroll a little bit more so you can all have a look at some of those other answers as well. But we appreciate you taking the time to reflect on that as we close out this module. And we'll now be going back to the presentation to do module 3. So I'll hand back over to Lois for that one, and I'll just start sharing the screen again.
Thank you, Fiona. So we've talked in the last session about, we've been focusing really on what to disclose. We've been through the 4 content areas, but I can see from the chat and the questions that a lot of your concerns about how. The standards are really easy to read, they're quite short, but what people seem to want to know is how. So we're going to look at that a bit now. But just to manage your expectations, the ISSB standards are about disclosure of information. They're not really designed to be about how certain things are done. So we've had a wonderful question about ensuring the rigor of internal carbon pricing. For example, what are the criteria? Now, the standards do say if you use a carbon price, please tell us, but it does not tell us how that carbon price should be constructed or by reference to which criteria. So the standards really are about what to report, not necessarily how to prepare the information necessary for disclosure. But we're going to tell you here as much as we can about how to across 3 different modules. First is how to identify sustainability related risks and opportunities, how to evaluate information for potential or actual disclosure, and how to integrate information in your general purpose financial report, however that is constructed in your jurisdiction. So let's start with identifying sustainability related risks and opportunities. Well, IFRS S1 asks companies to provide material information on all sustainability-related risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 says the same about climate-related risks and opportunities that could affect the company's prospects. So which risks and opportunities should they be? And what happens if there is not an ISSB standard on the type of risk or opportunity that you identify? For example, water, biodiversity, human rights. Well, on the subject of which risks and opportunities, the standard says to identify relevant risks and opportunities, a company shall consider the ISSB standards. So these can be accessed from the ISSB's websites. The ISSB standards set out what the types of topics, disclosure topics and metrics that are commonly used in different industries. So they're a really good place to start, and the standard requires you to consider them first when identifying risks and opportunities. So you may also consider IFRS educational material on sustainability related risks and opportunities. And in fact, there is this educational material available on the IFRS website. You can look at the CDSB framework application guidance. CDSB is one of the organisations that was consolidated into the IFRS Foundation, and there's some practical framework application guidance there. You could look at industry practice. For example, if you belong to an industry body, they may have issued some guidance that will help you on identifying risks and opportunities. But mainly the focus should be on the materials of standard setters and others that are focused on investor information needs. Having decided which risks and opportunities, you then referred really to the same sources that we've listed there for the purpose of deciding which information you actually disclose. But in this case, you may also use GRI standards or European sustainability reporting standards. So we're just going to look at an example now. This is again an example from Yara. It's a 2022 example. Remember, we saw this company earlier. They're an international crop nutrition company. And this is an example of how they've gone about identifying risks and opportunities. So it's not that they're referring to any of the guidance that I've just listed, but it gives you an insight into what approach they've taken. So they start by looking at global macro trends that inform and influence Yara's own market megatrends. So these are things like the changes in the population, geopolitical and trade uncertainties, the need for there to be circular economies to reduce waste, digitalization. All of these things provide the context and background within which risks and opportunities emerge. From those megatrends, the company has then looked at, well, what does this actually mean for our company? On the opportunities side, they show that shifts towards sustainability and transparency can be supported by the types of crop nutrition solutions that they are offering. They find digital tools helpful to help farmers communicate about things like yield and so on across using digital technologies. So there's a number of opportunities they identify that relate to those megatrends. Similarly, they see risks associated with regulatory changes and consumer demand patterns, greater environmental costs and taxes to do with sustainability outcomes, physical climate changes that can affect the company's operations and customers, very, very important to an agriculture and global crop nutrition company. So that's the way Yara did it in 2022, to sort of take the context and then identify company-specific risks and opportunities from that. Let's look at another example now, slightly different. This is an example from a company called Nest from their 2023 annual report. Nest is based in Finland, and it's a producer of sustainable aviation fuel, renewable diesel and feedstock solutions, and these are used in the chemical industry. So this is a company that's focused on helping its company to reduce their greenhouse gas emissions, and they're really working on sustainable products. What they've done here is to identify risks and opportunities. They've used 3 different scenarios. They've used and their temperature scenarios. So their net zero world is about a 1.5 temperature scenario. Net zero EU and North America by 2050 is about 2-degree scenario, and I think the compromised climate targets is a 2.5 to 3 degree scenario. So they describe the scenarios they've used in the first row. In the second row, they describe the opportunities that they see under each of those scenarios. So in the middle scenario, continued demand in renewable and circular solutions, of course, but they also identify the types of risks that they see. Now, the interesting thing on this example too is not only did they identify the opportunities and risks in different scenarios, but they also give us an indicative financial impact to the company. So you'll see that the most positive impact is in the net zero world, and you might expect that because this is a company that is dealing in sustainable products. And the most negative case is if there are compromised climate targets, which might mean, as they've said, that there's a more modest demand for their products. So it's a different way of looking at and assessing risks and opportunities, but very company specific. We're going on to something now that we've already talked about a little bit, so I won't go into this in too much detail, but the ISSB standards recognise that identifying risks and opportunities related to sustainability can be a very challenging but valuable exercise. So because it's recognised as difficult, the ISSB standards say that for the purpose of identifying your sustainability related risks and opportunities based on SASB standards and the other sources that we listed earlier, you need to use all reasonable and supportable information available at the time of reporting. Now, that should be specific to the company, and certainly we saw that with the Yara and Nest examples. It was specific to their companies. It should take account of the external environment. We saw that with both examples, with the megatrends that Yara looked at, with the scenarios that Nest looked at. It should include information about past events and current conditions that the company will know about from its experience, but also take account of forecasts. And in some cases, the types of information that should be taken into account is specified by the disclosure standards, as we've seen. So I'm going to hand it back to Fiona now to take us through the next part of the implement module.
Great, thank you, Lois. So moving on then within implement to evaluate. So of course, once those risks and opportunities are identified, companies will need to evaluate those financial effects from the risks and opportunities. And of course, we know, and probably reflected in some of the questions we've had from you all, this can often be one of the most daunting areas when first starting. And so here we're going to review some of the key concepts that we hope can help you get started in this process. So to help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. And it also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. So for example, you might test your company's resilience to a new regulation to limit certain high emissions activities, or your ability to respond to changing crop yields due to more frequent heat waves. So to do this, you'll need to use climate scenarios that are based on science and analyse how these scenarios will lead to the company's incurring effects. So it's important to remember scenario analysis doesn't mean that you are predicting the future. It's not a forecast or a prediction that should be given any ascribed kind of weight in that sense. It's really just a projection, a potential tool to test plausible possible futures and your resilience to those. So S2 doesn't specify which scenarios a company should use in the analysis, because this is likely to be highly specific to the types of risk you want to assess, the industry that you're in, etc. So there are lots of resources that you can refer to publicly for guidance on which scenarios to use for your sector. But some of the key ones that many organizations start with would be the IPCC climate scenarios, and as well as the IEA, the International Energy Association or Agency. But to use scenarios and provide information is really what this is aiming to do. So S2 asks you to disclose the relevant scenarios that you've used, provide information about how those have been selected, and what the key assumptions are that underlie those scenarios. The S2 standard then also includes guidance on how a company can determine its overall approach to scenario analysis. And this can consider a wide range of practice. So there may be a starting point with qualitative scenario narratives, where you may move towards more quantification and more complex modelling over time, focused on the most material issues. But overall, the recommendation or expectation is to use an approach that's commensurate with the company's circumstances, and to use all reasonable and supportable information that's available at the reporting date without undue cost or effort. So we'll zone in now on that to have a little bit of a look at an example. So here this comes from Cemex, which is a Mexican multinational buildings company active in over 50 companies. So Cemex in its scenario analysis uses a number of different scenarios. Alongside this table of risks and opportunities, it discloses the assumptions that sit behind each of these scenarios as well. And then in the table here, what you see is for each of their risks and opportunities that they've identified, they've assessed the probability and impact of those issues under the 3 different climate scenarios. And so what's interesting here is that actually overall, they're expecting to also see quite significant opportunities from climate. And so what's interesting there is obviously showing how that might differ under these different potential futures. And so also it's really good here to see that they have considered the alignment of their scenarios with sustainable development goals, etc. And so looking to those possible policy futures that we want to align to as well. So just a short excerpt, of course, with scenario analysis, there's often a lot of detail. So I recommend that you go away and have a read of this example and see if you can find some others online as well that might help you. So anticipating the materiality of future events can, of course, be very challenging. So to help with this determination, IFRS S1 asks you to consider a number of issues that will help you in your determination. And so there's a list here on the screen which shows all of these issues that you would want to consider. And so you can think of this list as identifying the steps and information you need to come to your overall judgment. So for examples, companies should be considering both low probability but high impact events, as well as those which it might expect to be more likely. And any uncertainty related to the company's future cash flows should be evaluated. So it's not that we expect a precise and definitive quantitative answer about a plausible future, but giving some clarity and transparency about what the ranges are, what the potential uncertainties and sensitivities are, is very useful to users of your information. And so another important point just to highlight here is that it's also necessary or recommended to reassess these uncertainties at the outset of each reporting period as well. Okay, and then that's evaluate, and I'll hand back to Lois for integrate.
Thanks, Fiona. So now we're going to look at the development of new processes or the use of existing processes to support your disclosure activities. So we've looked at identification, we've looked at evaluation, and this is the third concept that we wanted to discuss with you. And as you remember, when we looked at the risk management content requirements, those requirements were all about asking companies to disclose the process they use for risk management. So we're getting into that a little bit more. So what are some of the considerations that you might have when deciding whether to create a new process or to adjust existing processes or to use processes you already have in your organization? So the good news here is that when implementing sustainability related financial disclosure, you may well have quite a lot of systems, processes, policies already in place that you can use or adapt for your disclosures. So this is a good news story. So when you're considering that, what could you do? Well, do a gap analysis to check for any gaps in your existing systems and processes. On example, on new types of data that might need to be collected. You need to look at how suitable your existing processes are. Are they suitable for evaluating sustainability related risks and opportunities that have particular characteristics, more uncertainties attached to them, different time horizons attached to them? Do you need to make some adjustments for that? Same principle applies to the prioritization criteria you use. The criteria can be the likelihood, the impact, vulnerability, speed of onset. And this is where, as we mentioned earlier, there is some guidance in the public domain, for example, from COSO, that does set out the criteria that might usefully be used for sustainability assessment, if you like, assessment of risks and opportunities and what processes could be used. Same considerations apply to controls. Are the existing internal controls appropriate and suitable for using? Next question you might ask yourself is, which contributors do I need? Which departments could be involved? Which departments already have systems and processes and expertise that could contribute to sustainability disclosure, or might it be an external contributor? What interconnections are there between different internal and external factors that affect our disclosures? We saw earlier Fiona presented the World Economic Forum risk report. Is that an external factor that we need to take into account when considering how our internal processes work? I see someone's just mentioned the costs and benefits. Very good point. What are the costs and benefits of keeping things or changing things? And how do they work to support our disclosure practices? And finally, what resources might you need to obtain in order to manage existing processes or to get new ones? Anybody that's been through a change management request process will know that perhaps if you need more resources, this is something you need to get onto quickly to go through the change management process. So in your homework, we have suggested that you consider developing a disclosure plan that will bring together some of the points that I've just mentioned. Now, a disclosure plan can be a standalone strategy that describes how you're going to deal with sustainability related disclosure, or it can be part of a wider disclosure strategy that also takes into account things like financial accounting disclosure strategy or risk or governance or any of those wider types of disclosures. Now, a disclosure plan helps you take control of your narrative. I've seen some of you mention in the chat, you don't want this just to be a tick box exercise. The standards ask you questions about your organization, and having a disclosure plan that is very crafted to your organization can help you take control of your narrative rather than just doing a tick box exercise. The disclosure plan can support collaboration, knowledge sharing, and cross-functional team discussions within your organization. So you can actually make a list of who needs to be involved in this disclosure plan so that when you get to the next reporting year, you know who you need to collaborate with. You can set up a little committee that actually manages effectively the disclosure practices across the organization, that makes a list of the systems that need to be involved and so on. Who does this need to be? Is it people from risk management, company secretarial, procurement, finance, etc.? Make a list of them. How will data be sourced? Can you use your existing systems and controls to get it? All of these questions can be kept track of and kept a record of in your disclosure plan, and therefore it acts as a reference point and an audit trail to show you where and how judgments have been made, what are the sign-off procedures, what are you doing about assurance, which assurance standards you're using. You've got a complete audit trail and reference point for that. Now, we've got an old example here from Hammerson's 2022 data book, and there are lots of examples emerging about how companies are showing their disclosure plans. This is Hammerson, which is a British property company, but very briefly, what you see here from this tiny extract that comes from a much longer explanation is they set out the basis of their reporting on environmental and social impact on their business activities. We see the period covered by the disclosures. We see that they give us information about the approach they've taken, the scope used for their data collection, whether and how they've had information verified, and what type of information this applies to, including their greenhouse gas emissions. On the right-hand side of the screen, you can see that there's some of the greenhouse gas emissions covered by mandatory disclosure requirements. We can see which entities or parts of the business are included in the disclosures. Sometimes it's difficult to find information for all of your entities and activities, but they've been transparent about which are included, and they set out which standards they're using to inform their disclosures. So agreeing all of this is really helpful before you start on things like data collection, so you know what you're aiming for with a disclosure plan. So let's do a Zoom poll about this. You can only answer one of these, one answer only. Is a disclosure plan required by the IFRS Sustainability Disclosure Standards? Two possible answers. Yes, you must disclose your plan, or no, but it's a very helpful tool. What do you think? I'm giving you time to think about this. We have got over, well over 50% participating. I'm going to end the poll and share the results. Well, we can see across this wonderful audience, we're quite evenly split. Just over half of you said yes, and you must disclose your plan. Just under half of you said no, it's a very helpful tool. Those of you that answered no are correct. There is no requirement in IFRS Sustainability Disclosure Standards that says you must have a disclosure plan and you must disclose details of it. There are parts of the requirements that say you must disclose the method that you've used, the measurement method, the standard you've used, the approach you've used, yes. But there's no overall requirement to have an overall disclosure plan. So well done, just over half of you got the answer right, just under half of you got the answer right. But bear in mind that this homework we're giving you is really for you to test your own disclosure practices. Let's just consolidate this with our next Zoom poll. What does a disclosure plan help a company to do? And you can select all that apply, take control of its narrative within the general purpose financial reports, support collaboration, act as a reference point and audit trail for disclosure preparation, or skip full disclosure as prescribed by the ISSB. You're all responding much faster to this one, and I can see that you know the answers. So, because I can see you know the answers, I'm going to end the poll here and share the results. Of course, it's the first three. A disclosure plan is not an excuse to skip full disclosure as prescribed by the ISSB. It is to take control of narratives, support collaboration, and act as an audit trail. So thank you very much for your participation in that. Fiona's going to take us through the Module 3 summary now.
Perfect. Thank you, Lois. Okay, so end of module 3. So if you stayed with us this far, thank you for being here. We're really appreciating all of your engagement and questions throughout. And yeah, we're moving through to the final segment. So just to recap very quickly on this final, the third module that we've just covered. So a few things to come back to. As we've mentioned, connections are really key here. And what we learned here is that there are many connections between a company and its external and internal environment. And these connections are really key to focus on when we're identifying risks and opportunities. Secondly, we talked about the importance of being consistent and transparent in assumptions when evaluating risks and using scenario analysis. So whilst it's recommended or recognized that estimation techniques will be necessary, particularly for starting out and building quantitative understanding over time, of course, it's just most important to be transparent about those estimations and assumptions. And finally, as we've seen, often a lot of data that you may have in the organization here might not be something you're already disclosing, or it might be used for different reasons at the moment, but actually it can really help to inform reporting on these topics. So making sure not to start from scratch and to use that data you already have in your organization where you can is really important as well. Okay, so that brings us quickly, I'm going to be quite quick with this one just to make sure we have time for our final module and don't rush things too much, but a very quick final exercise to wrap up this section is just thinking about your data collection processes. So as we've mentioned there, you might already have existing processes that can help you here. Perhaps your enterprise risk systems, perhaps you're using other tools in the business already to collect data. And maybe your governance structures as well could support you here as well. So just a quick step into Menti just to reflect on how you can adapt your existing processes for data collection to support you in building out your understanding of these risks. So I see some of you have already shared your responses. So I'll start reading those out because we're a little tiny bit behind time and I want to make sure we have lots of time for the final segment. So 1 second, I'll just move that so I can see my screen. There we are. So I see a few people have already shared around using their health and safety reporting systems, maybe using HR data, exactly, your financial reporting systems, thinking about maybe environmental impact assessments exactly that you might already have in place in the business at an asset level. Maybe those can be aggregated up to tell you more at a group level. Thinking about integrating metrics into your financial dashboards. Good point. Tracking your strategies and talent development and performance evaluations. Deploying sensors to collect real-time data. That's quite an interesting suggestion for sure. So that can be very helpful when it comes to energy management, indeed, as has been highlighted. Someone has mentioned also the ISO standards, and actually if you already have these management systems in place aligned to ISO, you may indeed already be collecting a lot of useful information through those processes. Okay, lots of really good ideas here. I'll leave this open for people to keep reflecting, so just take a moment to put in your perspective and take a step back on what you think is most useful in your organization. But as we said, the really thing we wanted to highlight here is there's a lot that you can already use, hopefully within your organization, might already have been collected for different purposes, but making sure that you're drawing from what you have and you're building some governance around how you use that is really important. Great, so thanks everyone for sharing there, and that wraps us up on this segment. So moving us in to our final segment now on communication, which I'll be handing over to Robert for.
Great. Thank you, Fiona, and hello everyone. Indeed, we're now moving to the last unit of this and last module of this training, and which then focuses on when and where of the disclosure of sustainability-related financial information. And in this module, we have 3 main sections about location, about efficiency, how to achieve the efficiency, about confidence. So to get us started, we will then, in this section, first one, we will look at to clarify where sustainability disclosure should be located. And now, before we go into the details, let's think about sustainability disclosure in the context of a complete reporting package that is useful to investors. So investors already have access to companies' financial statements. ISSB standards are designed to identify sustainability-related risks and opportunities that complement financial statements. So these all come together in a reporting package that we can call a general purpose financial report. And this holistic package supports the dual purpose reporting model, where IFRS and FASB standards address investor needs, while GRI standards expand on sustainability metrics relevant to broader societal concerns. And together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader societal expectations and needs. So GRI standards expand on sustainability metrics relevant to broader concerns. ISSB and GRI reporting standards share some content requirements to what to report, but the ISSB standards are focused only on investors' information needs and decision making, reflecting the mission of IFRS Foundations to bring transparency, accountability, and efficiency to capital markets. Both organizations take different approaches to defining materiality, but they are not competing. The GRI approach is set out to understand is set out and understood among sustainability practitioners, whereas the IFRS approach is familiar to accountants and relies heavily on management judgment, aligning with existing corporate risk management processes. So together, these frameworks enable companies to meet the growing demand for transparent and consistent information, and aligning both investor priorities and societal expectations. So there might be how they can relate to each other and how where there can be a link. So you can think about the simple example where a double materiality assessment identifies that some of the company's impacts may also create risks, which could be so significant that they are important to disclose to investors. All right, and then again, a small recap, and then we'll think about what is material information. So as we just noted, materiality has different definitions for different reporting standards and audiences. In identifying material information to be disclosed, a company will first need to identify sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once the company has identified those risks and opportunities, it can then determine what information to provide. And this is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with definition in IFRS accounting standards. So it is the information that omitted, misstated, and if omitted, misstated, or obscured by other information could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. An entity determines what constitutes the sustainability-related risks or opportunity based on its facts and circumstances. So entities often have well-established processes for identifying, assessing, responding to sustainability risks and opportunities as part of their management of their businesses. And in the next slide, we will discuss how to disclose material information. So investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose information that is not material, even if the ISSB standards include a specific requirement. So things to remember. One must ensure that material information is clearly identifiable and that you use the plain language. You have to make sure also that material information is not scattered across your disclosure. And when including any additional non-material disclosures, if required by regulators, please ensure that it clearly identifies as such. So the IFRS also recently released a further education material providing guidance of companies on identifying and disclosing material information on sustainability-related risks and opportunities, which we would encourage you to look at for further detail. And there's a link to this material provided in the chat. All right, so now let's move to another Zoom poll, and we want to ask you a question about disclosing material information. So information should be disclosed in the annual report when applying ISSB standards if omitting the other information could reasonably be expected to influence investors' decision. Answer B, it could reasonably be expected to affect the company's cash flows. And C, exemplifies the values of the leadership team. Which of the three should apply here? And I see that answers are coming in and they're looking quite promising. All right, for the matter of time, I'm going to end the poll. And most of you are indeed right. So information should be disclosed if omitting the information could reasonably be expected to influence investor decision, and if that could reasonably be expected to affect company's cash flows. So A and B are correct ones. C, it's not about the values of the leadership team. So the answer C is incorrect. All right. And moving to the next section, the next topic about the location. So disclosure under ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But as one does not say where in the reporting package the information shall be provided, this is designed to allow jurisdiction-specific requirements on the location of the reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package at the company as the company's financial statements. They should also be provided at the same time as the related financial statements, cover the same reporting period, and be authorized by the same body or individual authorizing financial statements. And then in the next section, we will have an example about how that can be applied in practice about the company Ayala. Lois, over to you.
Thanks, Robert. Yes, we just had a question actually about, are there any requirements on presentation of information? And apart from, as you said, Robert, the information has to be in the general purpose financial report presented for the same period as the related financial statements. There's no sort of requirements on how to present information. You don't have to use numbers to say, yes, I'm here, I'm responding to paragraph 19. So this example shows one way in which a company might approach giving readers some information about how they have presented their information. It's from Ayala's integrated report. It's quite an, again, not their most recent report, but what we see from this one is that they've decided to organize their information based on the integrated reporting framework's value creation model. This means that down the left-hand side of what is effectively like an index to their reporting, they show us which capitals are used as input into the value creation process. So financial, intellectual, human, and social and relationship capital. In the middle, we see how value is created, and at the end, what value is generated. But from the point of view of effective communicating, what we see is references to page numbers, where we can find information about strategy or stakeholder needs, risks and opportunities, and ESG priorities and outlook. So all of these types of information are integrated into this integrated report, but you can navigate to them because we have these page number references, and you can understand them in context from this value creation model depiction. There's only one way of doing it. There are many other different ways you could use, but it's a snapshot that helps us navigate to where information is. Back to you, Robert.
Great. Thank you, Lois. Right, and so we now be going to another topic in this unit about digital reporting and technology. So technology is an emerging consideration for disclosures. Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those databases offered by stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards, so the taxonomy does not introduce any new requirement. A digital taxonomy provides the common elements or tags needed to make your sustainability disclosure machine readable. This makes it easier to take large data sets like information from an entire industry, bring them all together to analyze them. And the digital reporting has a number of benefits. It makes the reported information easier to use for analysis, and data is structured in the same way across businesses. Tagging information potentially allows for automated checks for quality and consistency, and more data collection and management systems are compatible with digital reporting taxonomies, improving processing and reporting preparation. Tags can have labels and description in multiple languages. So if you report your quantitative data in one language, someone speaking another language can also understand what it means. And now we're going to the next section in this module about efficiency and how to communicate efficiently and effectively. So, following the discussion on location and timing, let's now think about ensuring efficient disclosures. We added this to the training because a common comment we find from companies is that there is a growing reporting burden. What we hope to highlight is when done correctly, efficiencies can be made to reduce the burden. So first of all, it's important to understand what effective communication looks like and what is required. So often companies think that if they just put all the information they have into a report, then everyone will be satisfied. However, this would be against the core concepts in a particular third presentation. So, for example, it could be helpful to ask these questions. Is the information clear and concise? And by clear, we mean that it might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams, plus accompanying text. And to be concise, disclosure needs to avoid boilerplate information, unnecessary duplication, and to use clear language. And then continuing on the quality of information, some preparers watching today might be thinking to themselves that they still don't see what the fuss is about. So perhaps their experience focuses on standalone sustainability reports, or they haven't had much interaction with external audit. So to all the accountants watching, I would say be kind to your colleagues, help them understand the difference in rigor that required the data collection, oversight, sign-off, etc. So this means, for example, disclosures include comparative information ads are to be restated if necessary. Disclosures need to avoid unnecessary duplication and cross-references as required. Information has to be material, be connected, and aggregated or disaggregated appropriately. And then within this section, we're talking shortly about cross-referencing. So as you may have already noticed, there may appear some overlap across the disclosures topics. For example, you might have the same governance approach for all sustainability issues. And then, so rather to duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. So cross-referencing to other reports is permitted as long as the other report is available on the same time, on the same terms and at the same time as the sustainability disclosures. The cross-reference information is assumed to become the part of the reporting package. So cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. And how that can be achieved, we have another example. Over to you, Lois.
Thank you, Robert. And this is an example about cross-referencing, but also to sort of make us think about how climate disclosure is linked to financial statement disclosure. So this is an example from CRH PLC's 2022 annual report. So this was prepared before the ISSB standards were launched. And CRH is a provider of products for the construction industry. At the top of the page, the title tells us that the disclosure is about the impact of climate change and carbon emission reduction targets, and in particular, the impact on the financial statements. So the company starts by telling us here that they've identified climate-related risks, and we can find them on pages 56 to 59. So that's a cross-reference there to the page about the climate risks. But they also tell us that they've considered and assessed those risks when preparing the consolidated financial statements. Now, in the middle of the panel here, you can see that they say what lines of the financial statements they have taken into account when considering the effects of the financial statements. They've considered whether there are effects on impairment testing of goodwill, property, plant and equipment, whether there's been effect on the useful lives of assets, provisions for liabilities and so on. And we can see a cross-reference to the page numbers where those financial statements figures are. So we know from this that the company has sort of cross-referred between their climate risk assessment and the financial statements. They also tell us in here that they've made their judgments about this assessment based on the company's accounting policies, estimates and underlying assumptions. So we know the processes that they've used when making these cross-references. They tell us that their conclusion is that there is no material effect on the financial statements. So you might ask yourself, well, why are you telling us this if there's no material effect? Because we've already heard that a company doesn't have to disclose non-material information. However, the point here is that because this company has identified risks associated with climate change, the reader of the report might be thinking, well, surely there could be a financial impact. And what the company's telling us is that we have considered the financial impacts. You can see how we've cross-referred between different things, and you can see our conclusion that there is no material impact, and you know the basis on which we have made those judgments. So a little example with lots of information, and I'm handing back to Robert now.
Perfect. Thank you, Lois. Right. And the next topic we would like to cover here, it's about some mechanisms that support adoption and hopefully ease the burden. So as at IFRS, we have sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. So first, a simple thing to put in place was to adopt well-known terminology and concepts familiar to preparers borrowing from the IASB, for example. So secondly, many requirements in S1 and S2 are to be adopted proportionally. So recognizing companies will have a range of capabilities and preparedness on these issues. So for example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting date without undue cost or effort. Or another the term commensurate with skills, capabilities, and resources in a number of places across the standards. As thirdly, there are some transition reliefs for the first year of application, and this include companies being able to limit their disclosure to climate in the year 1 and begin reporting under other sustainability-related risks and opportunities in year 2. Companies also being able to provide annual sustainability-related financial disclosures with their next half-year reporting, rather than at the same time as the financial statements. And thirdly, companies not needing to provide disclosure about Scope 3 greenhouse gas emissions apply greenhouse gas protocol to measure emissions if they're already using different measurement approach, or provide comparative information in the first year of reporting using S1 or S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. And we've already mentioned a number of other resources, guidance, including ISSB standards, CDSB framework, application guidance, among many others. And so these reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality decision useful information. and the jurisdiction will decide when to mandate adoption, but the standards are effective from January 24, and we know many companies are preparing them to adopt them voluntarily. All right, and in the next section, we'll have a couple of polls again, just to reflect on the understanding of the information we've been just discussing. So, information disclosed in accordance with the standards should be, and then please select all the apply, decision useful, material, misleading, comparable. Which of those four are the features of the information to be disclosed in accordance to the standards? And I see this is a fairly simple question. Of course, you get it mostly right. So the information should be decision useful, material, and comparable. It should not be misleading. So C is incorrect. In the next Zoom, we'll have another question regarding the information. So information is decision useful if it is relevant and faithfully represent what it proposes to represent. It's comparable, verifiable, timely, and understandable. And see the answers coming in. So these are the characteristics of the information, and it's looking pretty good. You are correct. That's all these answers are the features of the information. So A, B, C, D, and E are all correct. So well done for the ones who responded this way. So finally, we will talk about the confidence and how to maximize confidence in disclosed information. So it's the very last section of this training. So an important trust builder is showing that data and trends over time. This is why ISSB standards asks for comparatives, and then comparative information provides context, helps to indicate progress, and underpins strategy and risk management. So metrics disclosed by a company might be redefined or replaced over time, or the company might change its method of estimating a metric. So in this situation, it's important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. So occasionally, a company's sustainability disclosures might contain material errors. So in this situation, the company is required to restate these errors in the comparatives provided. So revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. So, and the information can be qualitative or quantitative. So companies sometimes express concern with sharing the information they deem to be sensitive, and that if shared could deplete their competitive advantage. The ISSB standards relieve a company from disclosing such information about sustainability-related opportunity if that information is commercially sensitive. So if this is a concern you have, there is a further detail you can read out in the handout. All right, and the almost very last element we want to touch upon is a statement of compliance. So it's important to build confidence by providing clear statement of compliance. A company that complies with all the requirements of the standards, even the reliefs, is required to make the explicit statement of compliance. So we also published a further guidance on that in September 24, called Voluntarily Applying ISSB Standards, a Guide for Preparers. And in this last slide for today, for me, and things to remember, please walk through the list. You can find in the handouts a slide deck and additional slides in this section with reminders on how to report effectively and I highly recommend reviewing that. And with that said, I'm handing over to Fiona for the module summary. Thank you.
Thank you, Robert. That was brilliant. So that brings us to the end of our final talk module. So please do stay with us just to the very end of the session, because we've got a few important points we want to cover off with you now to wrap up the session and to answer some of those questions that we talked about regarding how to get your certificate, resources, etc. So 10 minutes to go, but we promise you it's worth staying for. So thanks for everyone's time and attention so far. So just to wrap up on this last module we talked about here, so we've discussed where to report information, and what was important here was the audience, or who you're reporting to. So making sure to be clear from the start who the primary user of information is, and this will help to ensure that the information you provide is right for their needs. We then talked about efficiency, and I think the key takeaway here is that less is more. So the objective isn't to overload investors with information, which actually, could be harmful to disclosures and obscure what they need to know. So really using the S1 and S2 standards to focus on material information for your investor audience is a good place to start here. And indeed, the key focus of the ISSB standards. And finally, we talked about report user confidence. So especially in the climate where we see many greenwashing accusations and perhaps legal battles over disclosures, you of course want to ensure that your data is not only accurate, but that it's presented in a way that builds confidence among report users. And so this is where the disclosure plan that we've been discussing throughout the session, and which informs the structure of the homework optional exercise you have, can really help you to do this. So if you take forward that activity in your organization, we hope that you'll have a clear and documented process for reporting the data you need to investors. So we're going to just very quickly wrap up on a final Menti exercise. So this is all just getting you to have a quick think about the presentation approach of your reporting. So how can you maybe thinking about potentially having a longer report, maybe with some of the extra reporting requirements you now have to integrate? How can you help support user navigation of the content? And there's a few ideas there, but I'll just take a quick trip into Menti with you to see what you guys think on this point before we close off. We do make you use your brain right to the end of the session, which I hope helps to keep everyone's focus and attention. We know it's a long time to be focused in an online environment. Okay, so lots of responses coming through there already, which is fantastic. Thanks, everyone. So ideas around having cross-references, infographics, maybe using previous data, thinking about table of contents, using clear structure and logic, graphics, comparatives, exactly using a digital format as well. We talked obviously about digital taxonomies, previously in the session, and those can be a very useful tool to structure your information. And linking, navigation, exactly. So I think you've all got the right sort of idea there and the kind of things that we would recommend. So probably covers off most of the key points that we would highlight, but probably just mentioning those benefits of digital reporting again, as we say, making sure to hyperlink and really showing within your report, the navigation pane of where the users are within the disclosure and which elements they've covered, I think can be really helpful. So thank you, everyone. Hopefully that's useful to just reflect on. And then last little question in Menti for you is, we talked at the beginning of the session, of course, about those learning objectives we had and where you were on those areas today. So whilst we don't promise to solve everything in a few hours, we hope that we have moved you along the curve on your understanding there. So I'll just give you a moment to let us know where you think you're up to against those different learning objectives that we set for the session. So I think I see that all of those areas look to have moved further along to the right than where we began. So that's fantastic. And in particularly the ideas on developing your strategy and explaining what the ISSB standards are look to have moved forward. So that's fantastic. Of course, we know with using the standards, there's no real substitute for getting on with that within your own organizations to build your understanding. So we hope you've given you some good starting points to build that area forward. So thanks for sharing that with us. So I'll leave you to respond to that, and I'll just pop into the slides again just to talk through those final few points, as I said, about your completion certificates, etc. Okay, so just to recap, we've mentioned several times about the homework assignment in this course. So that can be downloaded from the resources section of the event webpage. We have shared that link a lot of times in the chat, so hopefully you have that now, but I'm sure one of the team will just share that with you a final time again so that you can go back to that. As we've said, the homework is very much optional. There's no need to share it with us. We won't be able to provide any direct feedback, but we do hope that it's a helpful structure to share with your colleagues and to use to start to think about this plan, which, as we say, is not a requirement of the ISSB standards, but we think is a really helpful way to structure your thinking and support your internal implementation of the standards. So please take a look at that in your own time, and you should see that there'll be some familiarity and similarity in the structure to the content that we've covered in today's session. And we've talked about a lot of different resources today. And of course, whilst we try to share as many links with you as we can, of course, having some of these information in a similar single place to go to is very helpful. So a few key things to highlight here would be the IFRS's Knowledge Hub. So please do navigate to the Knowledge Hub on their website, which includes all of the IFRS resources, the industry-based guidance that they've talked about. So a really good repository for lots of information there. And as, of course, is worth highlighting, the two IFRS S1 and S2 standards are very much a key source, clearly, to mention. At the beginning of the session, our colleague Relitza from the IFC also highlighted the work of the IFC on the Beyond the Balance Sheet programme. They provide a lot of different training resources, guidance and support to build capacity in all areas of business and sustainable finance. So please do check out the Beyond the Balance Sheet resources from the IFC's website there as well, which you can access again in the handout or navigate to their website. And we've mentioned these throughout the session, but just to mention again, some of the SSE's toolkit resources that we provide to help you in this space, which again, you'll find on our website and in this handout. And so that brings us very close to the end. So a big thank you to all of you who've stuck with us throughout this full 3.5 hours of training. We know this is a long time to be together in the online environment and there's a lot to cover, but we're really appreciative of all of the engagement and interaction. And I think it might be close to a record for the number of questions our team have answered. So thank you for all of those questions, for keeping us busy as a team, working in the background, and we hope you've helped you move forward in those areas. So as a thank you for that hard work, you can now receive a completion certificate for taking part in this course. And in order to do that, you'll need to fill in a feedback survey. We will be sharing the link to this feedback survey in the chat with you now. And if you don't have the opportunity to click on this from the link shared in the chat, which you'll see shortly, Lois has just shared, we will also be sending this to all participants who joined us live in the session via email. Unfortunately, you can only receive the certificate if you join us live, not watch the recording. But if you access that link that's shared there or wait for the email that comes from us in the next 24 hours sharing that survey, if you then complete that survey, we will automatically send you a certificate of completion. And if you give us about a week from submitting your survey to receive your certificate, just to process all of those, that should come through to you. But if you don't receive it from us after that, then you can follow up with the team via the email address we'll share at the end of the session. If you are having any issue accessing that link, recommend copying and paste it into a different browser or trying it on a personal device. Occasionally, organizational blockers block it. It's a Google form. So perhaps try copying that link and sharing it to a personal device if any issues to access that there. But as said, you will receive that on email as well. Okay, so that brings us pretty much to the close of the session. So just to say a final few thank yous, firstly to the SSE's official supporters who make this programme possible, and in particular to the IFRS Foundation, to Bella, Vanessa, Robert, and of course Richard, who joined us at the beginning of the session, and the IFC team, including Relitza, for their kind support and collaboration on this training too. And lastly, a big thank you again to everyone who joined us here today. It's been great to have you here, and we hope to see you again on a future training session. So we'll close off there, but wishing you all the best. Thanks, everyone.